I've been trading for over 5+ years, and in today's video, I'm going to share with you everything that you need to know on how to start trading from scratch. This full course will go over the basics from candlesticks to market structure and liquidity, all the way to the strategy that I use every single day in the markets. If I'd known this information when I first started trading, it would have saved me hundreds of hours and thousands of dollars. So with that being said, let's not waste any time and let's get straight into the video. In today's video, I'm going to go over a full beginner's guide on how to start trading from completely scratch. If you're a beginner or an advanced trader looking for a roadmap on how to start trading, this video is for you. The goal of today's video is to share with you guys a complete roadmap on how to get started trading, from knowing nothing about trading to getting your foot in the door and understanding what trading is and the expectations you should have. One thing I want to mention before I get started is that a lot of people have misconceptions when it comes to trading, and I want to set the expectation straight that trading is not a get rich quick business. If you come into the markets wanting to get rich quick, this is not the place to be. Trading is the hardest way to make easy money. If you think you're going to make a lot of money consistently over a long period of time when you first start, then you need to have your expectations aligned straight. If you come into the markets with a gambling mindset, then trading is also not for you. And the last point I want to make, if you want something that's guaranteed, the market is not for you. Nothing is guaranteed when it comes to the market. The only thing that is certain when it comes to trading is that it is uncertain. So trading is all based off of probabilities, and that's what I'm going to share with you today. And as you can see, this is my P&L for October 2025. This was my last month's P&L, and I made over $65,000. And throughout the past year, I've made on average $50,000 per month. And most people may look at this and come into the markets with unrealistic expectations. What I want to mention here is that trading takes time. I've been trading for well over 5+ years now, and it took me years of losing in the markets in order for me to make consistent profits in the market. You see the wins now, but I've lost plenty of times. I've blown numerous accounts in order to get where I'm at right now. And you can still see based off the calendar, I'm not green every single day. There are going to be periods of drawdowns where the market is a lot harder, where you're going to have multiple losers. Sometimes you're losing multiple times in a week. Sometimes you have red weeks. Sometimes you have red months. That is what trading is all about. So understand that when you come into the markets, expect to lose before you win. And as I mentioned, trading is not a get rich quick scheme. It took me years of losing to see any results from trading. And I think this is the part where most people don't see, is because everyone loves to post wins, and it's very easy to post wins, especially on social media. But what you don't see is either the years of losing or losing behind the scenes. And that's why a lot of traders have this misconception when it comes to trading. But with that being said, trading is definitely possible if you put in the effort and you put in the hard work. And in today's video, I'm going to share with you the 5 main lessons that I feel like are the most important when it comes to trading in the market. So I'm going to go over my full trading course, starting from lesson number 1. Understanding candlestick formations along with candlestick patterns is very important, especially when you're a beginner trader. You want to understand the size of the candle, what candles are forming, right? The location of the candles, everything that has to do with candlesticks. Lesson number 2, how to determine market structures and trend, and understanding if the markets are trending, if we're ranging, are we going to trade the trends? Are we going to trade ranges? What is important? And then lesson number 3, how to determine key order blocks in the market. This is something very important and that changed my trading, is understanding what order blocks are and how to use them in the markets. Number 4, my full trading strategy and setups. This is what I use every single day. So I trade a mechanical system where I look for my trading strategy and the setups within the strategy itself. And then finally, number 5, how to find high probability entries, entering, how to manage positions, what to look for, and everything else. So that being said, let's hop on to lesson number 1 and let's get started. Okay, so the first thing that we're going to be going over today is a full candlestick guide on how to read candlesticks. Candlesticks is very important when it comes to trading, understanding buyers versus sellers, right? Candlestick formation, how big the candles are, the location of the candles. So we're going to go over a full guide on exactly how to read candlesticks. And then of course, we're going to go over a bunch of examples as well. Let's get into it. Okay, so in today's video, we're going to be talking about candlesticks, everything that you need to know about candlesticks and how to use them properly in the markets. So the first thing that we're going to talk about is the basics of a candlestick. We're going to talk about how they form, the open, high, low low closes. Then we're also going to be talking about the different types of candlesticks, the bearish versus bullish candlesticks. We're also going to be talking about how bullish a candle is depending on how it forms. Then we're also going to be talking about the bodies and the wicks, because that's very important when it comes to candlesticks and how they close. And then we're going to be talking about 6 different candlestick patterns that I personally use on a consistent basis. Of course, we're going to be going over examples as well. And then I'm going to go on to some real examples with context and logic to really build the foundation and how to use candlesticks properly with context and logic behind it to make it more repeatable and to give you more confidence when you're looking to take trades in the markets. So let's first start off on basics of a candlestick. And right here, as you can see, I have 2 types of candles. On the left hand side, what we have is a bullish candle, and really this candle means that buyers are in control. So whenever we have a green candle in the markets, that just means the buyers are in control of the market. And really what makes up a candle is how it forms. So what we have here is our opening price. We create a new low on the market, we drive price towards the upside, and then we have our high, and then we have our close. So what we have here is our open, low, high, close, and that's basically a bullish candle in the markets. Where on the right hand side, what we have is our open, which price opens up at the high, right? We make a new high for the market, we form a low, and then we end up closing to close off that bearish candle. And what we have in this case is our open, high, low, close, and this is what forms a bearish candle. And you'll see these candles are all over the markets. No matter what markets that you trade, candlesticks are the foundation in the relationship between buyers and sellers. And understanding this is just the basics of how candles form. And now we can go into the different types of candles that we can see that make up the market, because no single candle is going to be the same as its previous candle. And what I want to talk about is that not all bullish candles are equal. Similarly to the downside, not all bearish candles are equal. Every single candle in the market is going to tell us a different story depending on the context behind it as well. So the first thing that we have in this case is what's called an indecision candle. An indecision candle can be green, it can be red, but the main thing about this indecision is that neither buyers nor sellers are in control. What we have is what's called indecision, and you can see we have an upper wick, we also have a lower wick as well, and this usually just indicates that the buyers and the sellers are on par. Neither nor the buyers or the sellers are winning, and we're basically neutral, and that's what's called indecision. The second candle that we have is a nice bullish candle where really we're offering only upside. So you can see right here, this is a candle that we always look for. It's fairly bullish. Where we open, we have a very small wick, and then we end up driving price back towards the upside, and we also have a very small wick towards the high. So really, as you can see here, this was really a one-sided direction for the market. Really, buyers were in control of really the whole candle in this case, and this is what's called a bullish candle. So right here, what we have on the right hand side is our pin bar. There's a bunch of different names to call it. Really, the name doesn't matter. It's how the candle forms. And in this case, how this candle formed is we ended up opening, price ended up pushing towards the downside. So originally, right, the sellers were in control of this candle, but then the buyers started stepping in off the lows. We ended up pushing price back towards the upside, and then we ended up closing close to the high of the candle, indicating that buyers are clearly in control because sellers tried pushing this down, but the buyers instantly step right back up, pushing price right back towards the upside. And this is a very powerful candle in the right context. So what I have here is what's called their engulfing candle, and the engulfing candle is one of the most powerful candles in the right context. And on the left hand side, what I have here is a bullish engulfing. So what we have, the first candle, which is called their lead candle, you can see price, right, we open here, we end up having a fairly bearish close towards the downside, and then as soon as price opens at the bottom, what you would like to see on a bullish engulfing is that we engulf the full candle. So you can see that price pushes towards the upside. You can see we have a very strong body candle close as well. So basically the candle that we have currently engulfs its whole previous candle, which was red, and this signifies that price is very bullish. Whereas on the right hand side, what we have is a bearish engulfing. It's the exact same thing, but towards the downside. Price pushes towards the upside here. We have a fairly strong candle close, price opens, and then we have an immediate rejection towards the downside, and then price closes all the way down at the lows, showing that this is a very bearish candle. We also engulf its previous candle, we also close below its previous candle low, so signifying this is a clear bearish candle, and we can expect now continuation towards the downside. So now let's go into a chart to see exactly what this will look like. So right here, I'm on the charts, and the first thing that I'm going to mark out is this pre-market high level. This is the area of resistance that we end up dropping from the first time. So the next time we come back into the level, we're going to be looking for the reaction that we have off of your pre-market highs. So as I zoom in here, you can see this a little bit more clear. Price has that upper wick right around your pre-market highs. This is also your high of day level as well. We have a nice sharp reaction off this level. So now you can see what I have is its previous candle. So you can see this is a very small body that we've created, which is a bullish candle. And the next subsequent candle, we end up taking out liquidity, also closing underneath. So this full candle, so as you can see right here, this is a very strong bearish engulfing candle. So you can see this candle completely eclipse its previous candle's body along with its full candle as well, showing that this is a very strong candle push back towards the downside. And now you can see how price moves. As you can see, as price is pushing lower towards the downside, we have a couple candles here. We have another bearish engulfing, right? Continues the trend towards the downside, so on and so forth, where we have continuation lower. Price now comes back up for the retest of a super key level. And you can see right here as well, price comes up into this key level of resistance, rejects off this level. We have our bearish engulfing where it eclipsed the whole previous candle. And this leads the next wave towards the downside on this ticker. And you can see how important these candles are. And you can also see at the very low of the range, price actually has a bullish engulfing, and this actually leads this way back towards the upside. So as you can see, the bullish and bearish engulfings are patterns that are very important, especially at key levels of price. So understanding the candles along with the context around the candles is very important to understand if there's going to be a potential reversal or continuation of the overall market. Now let's go on to the second candle pattern. So the second candle pattern formation that we have is what's called our 3-bar continuation. So number one, what we have is our bullish 3-bar continuation. And what we like to see is number one is our lead candle, which we like to see bullish. So we like to see a nice strong push towards the upside. Our second candle in this case was called our indecision candle or our consolidation candle. So we like to see some consolidation, and we don't want to see a candle close above its previous candle high. So this basically just forms a nice little resistance here. And then our third candle is what's called that continuation candle and our confirmation candle that price is going to push towards the upside. And once we break above its second candle, and now what we like to see is a strong push towards the upside in the continuation of our trend. Now on the right hand side, what we have is the opposite, which is a 3-bar continuation towards the downside. What we like to see in this case is our lead candle be bearish, our first candle have a nice push towards the downside. Our second candle, indecision. We don't want to see a candle close below our first candle. And then our third candle is this continuation candle where we like to see it now close below its second candle. And now that will signify that price does want to continue lower towards the downside and push in the continuation of our trend. So now let's go on to a chart to see exactly what this looks like. So as you can see right here, I have the example pulled up, and a 3-bar continuation is a continuation play. So it's not a reversal. What you need is a clear trend in the market. So you can see right here, price opens up. We have this original push towards the downside. We're actually breaking underneath our opening range low. So now we're in a clear trend towards the downside because we're breaking underneath our opening range low. Now what we like to see is continuation towards the downside. So if I zoom in on price here, the first candle that we have to have is what's called our lead candle. As you can see right here, this is our first candle that initially pushes price towards the downside. So we have our first candle checked off. Then we have our second candle, which is going to be our indecision and candle that really is inside of its previous candle. So you can see right here, we have this nice push towards the downside. Now you can see the bodies where we're in between the body of its previous candle. So this is also checked off as well. Now what we like to see is continuation towards the downside. So we like to see the third candle, which is our confirmation candle, break underneath its previous candle low, which is the second candle's low. And this should indicate that price is going to continue in the trend of the overall market. So you can see right here, as price is breaking below its second candle, we also have a nice weak candle closure as well. And you can see price has this nice continuation towards the downside just based off of that 3 candle bar sequence that we just talked about. The way to actually enter on these 3-bar plays is on the breakout. I'm actually going to talk about one setup that I look for at the very end, which is my personal favorite. Since I don't trade breakouts, I trade the retest. I'll show you what the 3-bar play looks like on a potential retest, and I'll show you the different types of entries that we look for as well. Now let's go on to the third pattern pattern that we have. The third pattern what we have is our classic 3-bar reversal. This is one of my favorite patterns. As I mentioned, I talked about this earlier before. A 3-bar reversal is one of the most potent reversal setups that we can look for at key levels. So as you can see right here, what we have is a bullish 3-bar reversal. And the first candle that we like to see is our lead candle. So we like to see our lead candle push towards the downside. Then we have a reaction candle. So let's say we have a clear level of support here. Price reacts, which pushes underneath this key level. You can see that buyers are stepping in. And then on the final candle, what we have is our confirmation candle, which we like to see close above its previous candle. So and you can see in this case, we close above its second candle, but we didn't close above its third candle. And this is a solid 3-bar reversal. But the most bullish 3-bar reversal is when price actually closes above its first candle. When price closes above its first candle, that is the strongest 3-bar reversal. Whereas if it doesn't close above its first candle, it's still a strong 3-bar reversal, but not as strong as if it closed above that first candle. And on the right hand side, what we have is a 3-bar reversal towards the downside. What we like to see is our lead candle. So we have a nice bullish candle towards the upside, coming right into a key level of resistance. The second candle is what's called a reaction candle. You can see that price pushes towards the upside, but we close underneath our key level of resistance. And then our third candle takes us back towards the downside. We close below its previous candle. So now what we're looking for is this continued push back towards the downside. If you can have a candle close underneath its first candle, that's going to be a lot more bearish, but in this case, it's still weak since we did close underneath our second candle, indicating a potential shift in the market. Now let's go on to examples to see exactly what this looks like. As you can see, there's key highs and lows in the market. So you can see what we have is a 3-bar towards the upside. In this case, you can see price has a lead candle. We have our nice reaction candle. And then this candle, which is our third candle, you can see how bearish this candle is because it closed underneath our first candle. So I talked about that 3-bar reversal. The best 3-bar reversals will happen if the third candle closes underneath its first candle. This is one of the strongest 3-bar reversals. So you can see right at market open, price closes underneath its first candle and the second candle as well. This drives price all the way towards the downside. And now you can see as we're at the lows here, price forms a reversal towards the upside. You can see we have our lead candle. We also come right into a key level of support. You can see that this second candle is a reaction candle. Our third candle, it didn't close above our first candle high. So this one's not as strong, but you can see this is still a 3-bar reversal and we end up having this push back towards the upside. And you can see right here, price comes back towards the highs, where you can see another potential reversal in the overall markets where we have our lead candle pushes towards the upside. We have our second candle and the third candle. We close below its second candle, but not our first candle. You can see it took a little bit of a longer time, but we end up having this push back towards the downside. So you can see the 3-bar reversals and how they work. The strongest 3-bar reversal is going to happen when the third candle closes below its first candle in a bearish 3-bar entry. And in a bullish sequence, what we want to see is that third candle close above its first candle. Now let's go into the fourth candlestick pattern that we will look for. So what I have here is what's called our inside bar, and our inside bar is very important, especially on the daily time frame. It doesn't happen on the lower time frames intraday, but on the daily time frame, whenever we have an inside bar, what we can expect the next day is nice continuation to either side. So as you can see right here, what we have here is our inside bar. So our first candle is what's called our outer bar. So you can see in this case, what we have here is we have our high marked out. We also have our low marked out. And then the second candle, what we have is our inside bar. So you can see in this case, the candle that we currently have is inside of its previous day highs and previous day lows. Preferably for an inside bar today, what we like to see is a very small body. If we see a very small body, also small wicks as well, this really indicates that what we have is built up liquidity. And the way to trade the inside bars, we're going to mark out the previous day highs and lows. We're going to mark out the outer bar highs and lows. And what we like to see coming into this day is a break underneath its inside bar to target the outside bar. And we like to see a break above the high of the inside bar to target the high of the outside bar. So this is a classic inside bar day, and it's the exact same thing on the right hand side. What we like to see is a break of our inside bar to target our outside bar, and that's going to be key on the daily time frame. As I mentioned, the logic behind the inside bar day working is because there's built up liquidity. We haven't taken out the previous day highs and lows. So if you have an inside bar day, we can expect continuation to either side of the market to target those key liquidity levels. Now let's go on to a chart to see exactly what this looks like. So as you can see right here, what we have is a daily time frame. So the reason why the candles candles look like this is because it's a daily time frame. And a lot of times when you're on a daily time frame, there's going to be a lot of these wicks and these gaps and these imbalances. And that's what makes the inside bar effective. So right here, what we're going to mark out is the outer high. We're also going to mark out the outer low as well. And you can see in this candle, this is what's called our inside bar. So in this case, there's actually 2 days inside of this daily candle here. So this really just means there's built up liquidity on both these names. And you could see the next candle, once we broke underneath this candle low right here, which is our second candle, you end up having a nice push towards the downside. And really, if you broke it up onto the lower time frames, would really just look like something like this, right? We have our previous day highs, we have our previous day lows. Now what we have is a lot of consolidation. So you have a lot of consolidation, and majority of the times what we have is built up liquidity to both sides. We'll have some sort of wedge pattern that's forming, and that's why we can look to target this outer bar, or we can look to target the upside on the outer bar as well, because we're having built up liquidity to both sides. Now let's go on to the 5th candlestick pattern that I look for. So right here, what I have is what's called the 3 method pattern. And the 3 method pattern is one of my personal favorite patterns that I look for. And really it's broken up into multiple candles. And the first thing that we look for, similar to the 3-bar play, is we have our lead candle. So our lead candle, we like to see bullish towards the upside. And then what we like to see here is this 3 patterns right here. The majority of the times, right, we break above a key level of resistance. And now, right, we're having this lower volume pullback right in towards our key level of support. So a lot of times for the 3 method pattern, what we like to see is these lower wicks being put in, showing that buyers are stepping in. So you can see every single candle is pulling back towards the downside, but you can see these lower wicks indicating that buyers are stepping in. And then our final candle, which is our confirmation, which closes above all these candles. It closes above our first candle as well. And this just signifies that we're going to be having a continuation of the trend back towards the upside. And similarly to the downside, what we like to see is our first candle bearish. We have this nice continuation towards the downside. Then we have our 3 candles back towards the highs, where we like to see now these upper wicks here indicating that sellers are stepping in. And then our final candle, which is that confirmation candle that pushes price towards the downside, which closes below all our candles that we have, indicating that most likely price is going to continue towards the downside on the overall market. Now let's go on to the charts to see exactly what this looks like. So as you can see here, we're on the ES, and this is a classic example of the 3 method pattern. You can see we have a clear push towards the upside. So you can see the first candle is our lead candle. It's very bullish. We have a strong push towards the upside. We actually also break above this key level of resistance as well. So you can see price pushes above this high. And then what we have here is our 3 subsequent candles that push back down into where? A key level of resistance. So as I mentioned, right, context is very important. You see these 3 candles are pulling back down right into a key level of support. And you can see these red candles are showing these lower wicks as well, indicating that buyers are stepping in. So right here, I have this zoomed in. You can see price has a nice push towards the upside. Now it's coming right back into a key level support. You can see that the buyers are stepping in right off this exact level. And then we have our final candle, which is a strong candle closure. And we close above all these candles. And as you can see right here, this is a clear indication that most likely price is going to continue higher. And if I zoom out just a little bit, you can see price ends up pushing all the way back towards the upside. So as you can see right here, this 3 method pattern is very powerful. It's a continuation pattern of the overall trend, and this is something that we'll look for in combination with our other entry models as well. So now let's go into the final candlestick pattern that I look for. This is one of my personal favorites and one that I use every single day. As you can see right here, we're on my last candlestick pattern that I look for, and it's what's called the order block. So the order block is one of my personal favorites, and essentially means that if you're in an uptrend, what you like to see is down close candles supporting price towards the upside. If we're in a downtrend, we want to see up close candles supporting price towards the downside. So on the left hand side, what we have here is a 3-bar pattern. So when you're trading the 3-bar pattern, it's a breakout trade. You buy as soon as price breaks above its second candle, but I personally don't buy breakouts. So what I'm going to be waiting for is the retest. So I'm going to be waiting for the retest of this down close candle for this continued push towards the upside. So this was called the break and retest. And what we like to look for is break and retest off of order blocks or down close candles to support price towards the upside. So see, this happens quite often. If you mark out down close candles in an uptrend, this is exactly where we're going to be looking to buy, with a stop just a break below the order block. And now we can have clear targets back towards the upside. On the right hand side, what I have is a bearish order block. And on the downside, what we like to see is up close candles supporting price. So in this case, price has that candle close below, and the order block is valid once it closes below its previous candle. If you guys don't know how to draw order blocks or how to use them, I have a full in-depth video on exactly how to draw order blocks. As you can see in this case, price breaks below. So instead of selling selling once it breaks underneath the second candle. What I'm going to be waiting for is the retest off of your up close candle for this continued push towards the downside. And similarly towards the upside, we're going to be looking for entry with a stop just to break above this order block. And we're going to be looking for this continued push back towards the downside. So now with this being said, let's see exactly what this looks like on a chart. So as you can see, what I have here marked out on a chart is I'm going to mark out your pre-market high. This also coincides with their open. We actually end up having a 3 method pattern towards the downside. You can see we have our lead candle price, we have 3 up close candles, and then we end up having our candle close underneath its first candle, right? Signifies that price is most likely going to continue towards the downside. So you can see our trend is already towards the downside right off the beginning of the day. Now what we're going to be looking for is up close candles. So in this case, every single time price makes a new low, what we can mark out is our up close candles. So if I zoom in here, you guys can see this a little bit more clearly, but once price closes underneath, what we can mark out is our up close candle. Instead of buying the breakout, as I mentioned, what I'm going to be doing is waiting for the retest. So you can see price comes right back into this order block. It wicks above it, but closes underneath this 1 minute order block, signifying that price is most likely going to continue lower. You can see nice reaction right off our 1 minute order block. And then we have this nice trend towards the downside. And we can also keep marking out order blocks as well. If we mark out this order block, see that price heads lower, comes back up to the retest. We have more continuation towards the downside. So as you can see, the order block is one of my personal favorites in combination with other confluences as well. That's something that I want to mention here. Patterns don't mean anything without context and logic. What you don't want to be is a pattern trader. I just talked about a bunch of different patterns that you can use and that I use on a consistent basis, but I only use these patterns in combination with context and logic because that's really what builds the confidence and allows me to take these trades. If I strictly just look for these patterns without any context, it's going to be very hard for me to have a repeatable and consistent system where I can make a lot of profits in a long period of time. I have to have the context and logic being built around the patterns, and that's what can give me a high probability trade. And that's why I always try and preach to you guys is logic and context is one of the most important things, and patterns in itself does not mean anything. So the last slide I have here is just key things to note. Wait for the candles to close. As I mentioned, wicks do the damage, bodies tell a story. It's so important to understand that the candle close is the only thing that matters. If you make decisions before the candle closes, it's going to be very hard because the candle close is what's going to tell you the story. If you buy in before the candle closes and it has a huge wick, just understand that thesis can be completely invalidated depending on how that candle closes. Number 2, candlesticks are the most powerful around key levels. So I talked about these candlesticks and these patterns are very good, but what matters is the context and where the candles are in relation to the higher time frames. And the best key areas to look out for are the higher time frame key levels and also key pivot points on the chart. Another thing to mention is that higher time frames hold more power. 61 minute candles equates to 1 hourly candle. So if you have a 3-bar reversal on a 1 hour candle, it's going to be a lot more powerful than a 3-bar reversal on the 1 minute time frame. Next, we're going to go over a full market structure guides and how to read trends in the markets. Understanding market structure and if the markets are trending or for ranging is very important. The strategy that I'm about to share with you later into the video works best in trending markets, whereas if we're in ranging markets, we have to be more cautious. So with that being said, let's go over a full market structure guide and how to read trends in the market. Let's get into it. So we're going to be talking about market structure today, why it's so important to understand market structure, how to identify market structure, and how you can use it to make money in the markets. So as you can see right here, what I have is my 3 core principles to understanding market structure. Number 1, the first thing that we want to look for is identifying trends in the markets. So the basics of market structure is being able to identify trends. If we're in an uptrend, if we're in a downtrend, if we're consolidating, this is the basics of market structure, is being able to identify these trends on the higher time frames. Next, what we're going to be looking for is determining the difference between a fake out versus a continuation. A lot of times the setups look fairly similar, especially on the lower time frames, but there's a key difference between a fake out versus a continuation, and I'm going to talk about it a little bit deeper later in this video. And then finally, what I have is understanding the difference between micro and macro trends in the markets. There's differences between a macro uptrend with a micro downtrend. That's what we're going to be talking about and why it's important to identify the difference between macro and micro trends in the markets and how we can use them to make money. So now let's go on to identifying trends in the markets. So as you can see right here, what we have is basic market structure. So in this case, on the left-hand side, what we're creating is higher highs, higher lows, higher highs, higher lows, and we're continuing towards the upside. So this is what's called an uptrend. And whenever we break above this key level, this is what's called a break of structure. So a break of structure occurs in the direction of the trend. So every single time it breaks above this key swing high, this is a break of structure towards the upside. And once again, once we break above this key swing high, what we have is called a break of structure. So when price is continuing to make higher lows in the market, this is when we know when we're in a clear uptrend. Versus when we're on the right hand side where price is making lower highs, lower lows, lower highs, lower lows, lower highs, and we're continuing towards the downside. In this case, what we have is breaks of structure towards the downside. In this case, the trend is towards the downside. So every single time it breaks below this key swing low, right, what we have is a break of structure continuing the trend towards the downside. So in this case, we're making lower highs, right, lower lows, and lower highs, and we're continuing towards the downside. So clearly we can see on the left hand side what we have is a clear uptrend in the market, and on the right hand side we have a clear downtrend in the market. And of course, right, this is the basics of market structure. And you might be asking, price doesn't always look this clean, and you are correct. So you can see the reality of market structure is that price is not always going to be super clear. So you'll see that price is not always in a clear trend towards the upside or downside. And this right here is usually the reality of market structure. It's not always going to be the cleanest on the higher time frames. So let's break it down and see exactly what we're looking at. So you can see right here, what we have is a clear trend towards the upside. We have higher highs, higher lows, where we're breaking structure. This is a clear trend towards the upside. We have a break of structure. We're creating a new high. We have another low put in, and now you can see right here, we make a lower high. So we make a lower high right here, and then what we have is price is technically breaking underneath this swing low. So we break underneath this swing low, but you can see price is still bullish on the higher time frames because we're still making this higher low off this key pivot point. So you can see that price, as long as we maintain above this key area, we're still in what's called a bullish uptrend. So we're still in a bullish uptrend, and you can see price, we finally break structure back towards the upside right here. This right here is what's called our break of structure. You can see price, we make a new high, where we're creating these higher lows, where we're building up towards the upside. Similar thing once again, price breaks underneath this key swing low right here, but you can see that price is still holding our higher low key pivot areas. So you can see price creates a double bottom, right, in an uptrend. Double bottoms are very bullish, and we're continuing towards the upside. You have another break of structure back towards the highs, and we finally make a new high. In this case, price pushes towards the downside, right? We're still very much in a bullish uptrend all the way up until the end where we break underneath this key low right here. Once we break underneath this key low, which is your double bottom, this is now what's called a change of character. Right, so every single time before, when we're having these mini breaks of structure towards the downside, we're still in a very clear uptrend. But in this case, we finally break underneath this double bottom, which signifies that price is starting to head in a potential downtrend. So now this is what's called a change of character. Breaks of structures are continuations of trends. Changes of characters are a break of a trend. So in this case, price breaks underneath this double bottom. So now what we can see is a potential downtrend in the overall markets. So let's go on to the next slide. The next slide I want to talk about is strong versus weak structure. As I mentioned in the last slide, sometimes structure is not always perfect, but how can we identify strong structure versus weak structure? In this case, what we have is strong structure on the left. So in this case, what we have is a clear uptrend once again. Clear uptrend, higher highs, higher lows, higher highs, higher lows, higher highs, right? This is what's called strong structure. When price is using these key previous resistance turn into support levels and we're holding these key areas, this is by far the most bullish. Or vice versa towards the downside, when price is using those support levels turn into resistance, that's when we have strong structure towards the downside. And you can see once price right here, we break structure towards the downside, right? We're still in an uptrend, as you can see right here. We're still in this uptrend because we're making a higher low off this area. as you can see right here, price fails to make a new high, right? Price fails to make a new high. And now you can see what we're having is a lot of internal liquidity, right? Price is breaking above the high, right? Taking out the liquidity, just coming back inside the range, not really too much displacement. We're just coming back. We're still in an uptrend, but we're slowly making its way towards the upside. And that's not what we like to see when we look to trade. What we look for is strong structure. We like to see displacement where price has a nice push above the swing high key pivot point. If price breaks above the swing high, but quickly reject, that's potentially what's called a fake out, which I'm going to talk about next as well. And right here, this is going to be the difference between a fake out and continuation. So you can see price moving towards the upside, higher highs, higher lows, higher highs, higher lows. We end up using this area as a retest. Price breaks above this swing high, but fails to have a candle closure, fails to displace above this level. We reject, sellers start stepping into the market, and now we take price towards the downside. Whereas on the right-hand side, what we have is continuation, where price is making higher highs, higher lows, higher highs, higher lows, higher highs, and higher lows. And we're holding these key areas of break and retest. And you might be asking, how do we determine the difference between a fake out where it goes to take out liquidity versus continuation where we have markets holding key areas in the trend of the overall market? As you can see right here, the main thing is understanding the higher time frames. So you can see the higher time frames in this case is bearish. We're making a lower high, lower lows, lower highs, lower lows, lower highs, lower lows. In this case, what we have is a mini uptrend. So now you can see price, we push back towards the upside. We finally have our change of character, a break of structure, and now we have our retest. So as you can see right here, this is now a miniature level of resistance turning into support. This might look like a super solid buying opportunity on the overall market, but you can see if we are going to look to buy in this area, what happens? Price has that push up, we take this swing high out, but what happens? We sharply reject off this area and we end up continuing towards the downside. The reason being is because you can see the overall higher time frames. Price is really just returning back into this higher time frame break and retest level. Your previous support really acting as resistance, and you can see this would actually be a really solid area where you should be looking to take a sell position towards the downside. So you can see in this case we have a lower time frame break and retest, but the higher time frame is bearish. So if we don't understand the higher time frames, it's going to make it very difficult for us to trade in the markets. And now you can see the exact same thing, but now this is a continuation, right? The difference between the two is that in this case, right, the higher time frames is bullish. As you can see right here, we're creating an uptrend where we're creating higher highs, higher lows. As you can see, right, we're creating this double bottom in an uptrend, and price in this case is using these key areas of break and retest. You can see price where we're coming back into key areas of break and retest, another swing high made using this area as support for that continued push back towards the upside. And the reason why we have continuation is because the higher time frame is bullish. These dips are most likely going to get bought up because we're in an uptrend. If we're in an uptrend, we can expect every dip to get bought up and create higher lows in the markets. If we're in a downtrend, we can expect most pops to get sold to create a downtrend. So as long as we understand the trend of the markets, we can capture either the upside or the downside. We don't have to worry about if price is trending towards the upside or the downside. As long as there's a trend in the markets, we're looking to capture a move within the trend of the market. So now let's go on to micro and macro trends. So now let's look at micro and macro trends. As you can see right here, we have another clear uptrend in the markets. We're creating higher highs, higher lows, higher highs, higher lows. What we're going to be looking for is this previous swing high to now be used as support for that continued push back towards the highs. So you can see in this case, what we have is a 1 hour chart. And on the right hand side, what we have is a 5-minute chart. So you can see I have this color coded here in red. This is the mini downtrend. So you can see in this case, what we have is a macro uptrend where we're creating higher highs, higher lows, We're continuing towards the upside. But what we have is this leg in price right here, which is color coded in red. So this is on the 1 hour time frame. On the right hand side, if we're having a pullback on the 1 hour time frame, what this is going to look like is a downtrend on the lower time frames on the 5 minute or the 1 minute. So you can see in this case where we're creating lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, and we're coming back into key areas being that higher time frame point of interest. So you can see the blue line will be your key level of resistance turned into support on the higher time frames. So this is the area we're going to be looking for potential reversals in price. When price taps back into our higher time frame break and retest level, we're now going to look for signs that price is going to flip back bullish on the lower time frames. So we know that the higher time frames is bullish and we have a mini downtrend on the lower time frames. We're going to look for a change of character on the lower time frames to now flip back bullish. So you can see in this case price, we have that change of character as you can see right here in price. When price breaks back above this swing high, price now flips back bullish. And now what we're going to be looking for is any sort of key areas for that continued push back towards the upside. So this is basically what my model looks like, right? Once we break structure, as you can see right here, we're going to be looking to trade price back up in towards our key areas, risking off this key swing low. So on the higher time frames, what it will look like is this nice break and retest on the higher time frames with a stop just to break underneath this key area. So essentially what my strategy is looking for these macro uptrends, and I'm looking for micro downtrends to flip back bullish. So I start having a micro uptrend in a macro uptrend, and that's when everything starts aligning and I can look to target those higher time frame key levels. So now let's put this all together and go look at some examples in real time. So right here, you can see that we're on SPY and we're going to analyze the market structure on the higher time frames. And then we're going to go into the lower time frames to see how I trade this in real time. What you can see right here is that we're in a clear downtrend in the overall markets on SPY, creating lower lows, lower highs, lower lows, lower highs, lower lows, and we're continuing towards the downside. So in this case, the key level for SPY is going to be this key area right here, right? This is your change of character level, your previous support turned into resistance. If SPY can break back above this key area, then we can look for a potential move back towards the highs, towards your key levels, towards the upside. So now let's play out the tape on the higher time frames. So you can see right here on the overall market, price is no longer bearish. We reclaim this key area on SPY. We're no longer bearish, and now we're going to be looking for that continued push back towards the upside. So now you can see we have that big push coming into pre-market. We have a clear uptrend. We broke structure back towards the upside. We're above our key swing high pivot point now. So what are we going to be looking for? This was our original swing high pivot point. Now we're going to be using this area as potential support for that continued move back towards the upside. So now we can play the tape coming to market open. So you can see right here coming into market open, we're very much bullish. So we're bullish now on the higher time frames. We're in a very much clear uptrend. What are we going to be looking for? Our key areas is all the way down towards our 586. So we know that this is a higher time frame point of interest. We're going to be looking for this area to be used as support for that continuation back towards the upside. So as you can see here, as we play out the tape, price is now pulling back down in towards our key area. So the higher time frame is bullish. We have a 5-minute downtrend. If I go into the 1-minute time frame, you can see we have a 1-minute downtrend as well. So what do we have here? We have a higher time frame macro uptrend, and now we have a micro downtrend on the 1 and 5-minute. So now we're going to be waiting for the 1-minute to flip back bullish for a push back towards the upside. As you can see right here, this is where we get that change of character back towards the upside. We break above this swing high. Now what we can look for is all dips to get bought up for that continuation push back towards our higher time frame objectives now. So now we're going to be looking for the retest. You can see price, nice reaction off our key retest level. That's where I look to get in with a stop just to break below. And now I can look to target those higher time frame key levels. So if I move back on the higher time frames, in this case, my higher time frame key level, since we're at all-time highs, is going to be this pre-market high all the way back here. So this is going to be my key area for SPY that I can look to target. Now we can go back and play out the tape. So as you can see right there, SPY ended up hitting my main target, which was my pre-market high, or that all-time highs level that I made in the pre-market. In this case, I actually ended up taking a couple scales along the ways, but I ended up holding my major position for that higher time frame key level. So in this case, it would have netted me $1,800. What I actually made in this day was over $6,000. So now we can continue to play the tape on Tesla to see what it would look like on the next session. So you can see I played the next session towards the next day. You can see we're still clearly in a higher time frame bullish environment. We're creating higher highs, higher lows. We're holding key areas on the SPY. What we're going to be doing is looking for continuation towards the upside, right? We have a higher time frame macro uptrend. What are we going to be doing? We're going to be looking for any sort of micro downtrends to flip bullish to target those higher time frame objectives. So in this case, so as you can see right here, I'm on the 5-minute chart, and I'm going to mark out a couple key levels. I'm going to mark out your previous day highs, and I'm also going to mark out your pre-market high key area as well. In this case, right, as I mentioned, higher time frame, bullish uptrend. We're now looking for any sort of pullbacks on the lower time frames or for any sort of bullish setup for continuation higher. Now I'm on the 1-minute time frame. You can see that price is now using our opening range candle, right? Pre-market high. We're getting above this key area. Let's see if we can end up using this area for potential continuation back towards the highs. So yeah, price, we have a nice break towards the upside. We're getting the buyers stepping in off our opening candle print, off our key area as well. This is where we can look to take price with a stop just to break below. And we can look in this case, right, since we don't really have any targets, since we're at all-time highs, we can target a 1-to-2 risk to reward ratio. And you can see right there, price ended up hitting our target fairly nicely for another win on the day. But let's go on to the next session. So as you can see right here, we're on the next day again, and we're still in a very much clear uptrend in the markets. So if we're in a clear uptrend in the markets, what are we going to be doing? We're going to be looking for long positions towards the upside. Since the higher time frame is still bullish, we're going to be looking for continuations higher. So you can see that coming to market open, the key level that I'm going to mark out is this key area, which is your previous day highs. We can also mark out our key area as well and drag this over. And now we can go into lower time frames to play the tape. So as you can see, coming to market open, this is our key area on SPY. What I really want to see is a break above this previous day high area for that continued push back towards the upside on the overall market. You can see that price is trying to close above this area. What I like to see is some displacement, a retest of this area for that continued push off your 496.65. So you can see we finally close above highs. What we can be looking for now is the retest. As you can see, we're getting the retest here nicely. That's where you can go look long with a position off this retest level with a stop just to break below. And you can look to target a 1-to-2 risk reward ratio. So you can see right there, we had another nice win on SPY towards the upside. The structure on the higher time frames was bullish. And now we go on to the lower time frames to look for any bullish setup for continuations back towards the highs. So now let's go on to the next session on SPY. So as you can see right here, we're on the higher time frames. We're still in a very much clear uptrend on the overall market. So if we're in a very much clear uptrend on the overall market, what are we going to be doing? We're going to be going on to lower time frames to look for any micro downtrends, to look for a continued push back towards the upside. So now let's go into lower time frames. Right here, you can see the key area I'm going to have marked out is your previous day highs. So we're going to be using this area as a potential move back towards the upside. Coming into market open. So you can see price is now tapping into our key area, which is your previous day highs. So we'll be looking for potential continuations back towards the upside. So right there, we can look for a position off our key area, right? Nice reaction off this area. Stop just to break below. And in this case, we can look to target your pre-market highs back towards the upside and drag this up. Now we can play out the tape. You can see right there, we would have ended up getting stopped out for a loss. In this case, this was a super solid setup. This was higher time frame bullish. You had a nice strong reaction off your previous day highs, right? You're looking for continuation towards the upside. In this case, you're up 3 days in a row. 4th day on SPY, you're bound to take a potential loss in this case, but this was a super solid setup. And now let's go on to the next session. As you can see, we're back on the higher time frames. We're creating higher highs, right? Higher lows, higher highs, higher lows. But in this case, what we have on the previous day is we actually broke underneath this key pivot point. So now we have to be very careful and we want to wait for extra confirmation that price wants to continue back towards the upside. So now let's go on to the lower time frames and we can mark out key areas. So I'm on the 15-minute time frame and we can refine our key areas now. So price, as I mentioned, we have to be fairly careful because now we're not above our previous day highs on SPY. And our key area now really of our level of support is all the way down towards this 596. So we can drag this level, refine our key areas and mark this out, which is our 496, multiple touches around this area. So what we want to be doing is really looking for price to come back in towards this level for potential kind of positions back towards the upside on the higher time frames. So let's go into the 5-minute and see that price is pushing towards the upside so far. What we have is a pretty big candle underneath your opening candle range low now. So what we can be looking for on the 1-minute time frame is a potential retest of this area for a quick scalp towards the downside. So what this is right now is we're looking for an intraday bearish setup to target those higher time frame key areas. So now let's look to see if we get that retest. Price coming back to retest this area. We'll wait for weak price action. You can see we get that weak price action off our key area. That's where we can look to go in short with a stop just to break above, and we can look to target low of day and continuations down towards our key areas on the higher time frames. Now play with the tape. And you can see right there, price ended up tapping into our higher time frame point of interest fairly nicely, where we would end up closing our short position because that was a higher time frame point of interest level. Next is how to identify order blocks. Order blocks is very key when it comes to the market, especially trading in trending markets. Understanding that down close candles support price towards the upside and up close candles support price towards the downside. Order blocks is very important, and when I was able to identify order blocks and understand what order blocks are, was actually a very key pivotal moment in my trading. So with that being said, let's go over how to identify order blocks. And then of course, we're going to go over live examples as well. And what is this strategy slash concept? And the strategy slash concept is all reliant on one candle. And what we're going to focus on here is up close candles, which are green candles, and down close candles, which are bearish candles. And all we're doing is looking for up close candles to be respected in a downtrend and down close candles to be respected in an uptrend. And that's the basics of how price moves. Of course, we're going to go into more detail. We're going to talk about confluences, the different types of higher time frames, along with setups that we can use in combination with the one candle. We're then going to talk about entries, stop targets, different types of entry models. Where should we place our entries when we're talking about the one candle, along with examples, of course, at the end of the video. So what is the one candle slash order block? So I personally call it order blocks, or some people call it the one candle. There's a bunch of different names for it, but all we have to know is that it's going to be a down close candle in an uptrend and an up close candle in a downtrend. An order block is an area where large market participants have placed significant buy and sell orders. Order blocks are key levels slash areas where there's lots of liquidity on the chart. Institutions and market makers will place their orders in these areas of significance. So with this being said, we understand that order blocks are going to be key levels on a chart. So we really want to know how to identify these key areas and levels to be able to identify potential trading opportunities in the markets. So number one, if we want to identify our one candle slash order block, what we want to be looking for, number one, is a trending market. So a trending market in this case is going to consist of higher highs, higher lows, higher highs, higher lows. So we either need an uptrend or we need a downtrend in the markets. What we don't want is where price is consolidating in a range. There's also different types of order blocks, which are reversal order blocks. Strictly in this video, we're going to talk about my personal favorite, which is going to be continuation order blocks. So that's number one. Number two, what we want to do is mark out any sort of down close candle that is in a uptrend. So in this case, you can see we have a clear uptrend towards the upside. Now what we're going to be doing is marking out down close candles. So you can see price has a nice push towards the upside. Once we close below our down close candles, what we can do is mark out from the wick to the body. That's the easiest way to identify an order block. You can see price pushes higher, respects our down close candle. Once again, we have another push towards the upside. So once we break above this down close candle, we can mark out the wick to the body once again, and you can see price respects this and continues towards the upside. So all we're doing is marking out down close candles in an uptrend, and when we're in a downtrend, we're going to be marking out up close candles. So we're doing the exact opposite. You might be asking, there's so many down close candles in an uptrend. Which one should we choose and which level should we trade off of? So what we want to do is mark out down close candles in an uptrend. So on the left-hand side right here, what we have is our highest probability to our lowest probability order block. So in this case, what we're going to do is mark out the area from the wick to the body. A lot of people always ask, do I draw levels from the wick or do I draw levels from the body? And the right answer in this case is we're going to draw out the whole area, right? Because sometimes price will respect the wick, sometimes price will respect the body, but in this case, it's this general area that price has to respect for continuation towards the upside. So as long as you can maintain this area, right, we can expect price to move higher. So this is going to be our highest probability order block. The actual order block in itself is the full down close candle, but you'll see the highest probability is going to respect from the wick to the body. The second one, so in this case, what we have is a very small wick. When this is the case, when price has a very small wick, we want to give it a little bit more room. So instead of marking out from the wick to the body, we're going to mark out from the top of the wick all the way to the bottom of the body. So in this case, this is our second highest probability order block. What we want to see in this case is price respect this for this continued push towards the upside. And then on the right hand side, what we have is our lowest probability order block when we have a full down close candle. This is where we draw it from the top of the body down all the way to the bottom of the body. And this is where when price gravitates higher, right, we have no wick. So price can bounce either at the top, it can bounce in the middle, or it can bounce all the way at the bottom of the order block. So that's why this is the lowest probability, is because it can bounce anywhere in this general area. Whereas if you have a highest probability order block, you want to see it bouncing at the top of the wick all the way to the top of the body. So this is what's classified as our bullish order blocks. As I mentioned, we're looking for down close candles in an uptrend, and we just went from the highest probability down to the lowest probability order block. And what does this look like here on a chart? So what we're going to do is mark out down close candles in an uptrend. So as you can see right here, this is the first down close candle. You can see price respects from the wick to the body. Nice continued push towards the upside. We can mark out our next down close candle. When we close above, you can see price breaks above, respects the wick, has a very strong push towards the upside, and then we can mark out our next down close candle. In this case, we can draw our full candle. Of course, we want to see price respect the top of the wick to the body. We were respecting it. Once we broke back underneath, we actually gravitated towards the low of the order block. The low of the order block held, and you can see eventually we gravitated towards the upside. So if we can hold the top of the wick to the body, that's when it's going to have the most momentum. If we gravitate all the way down towards the low of the order block, we're still bullish, but that just means it's going to take a little bit longer to gravitate back towards the upside. So you can see here, price pushes back higher, and we can keep marking out these down close candles, and then we can see price ends up continuing back towards the upside. Now let's take a look at the opposite, which is up close candles in a downtrend. So when we're in a downtrend, we're looking for up close candles. On the left hand side, we have the highest probability. What we're going to do is draw it from the wick to the body once again. This is where we want to see price respected. So if you close underneath, you want to see the retest and hold underneath this order block for continuation towards the downside. In the middle, what do we have here? We have a very small wick. So what we're going to do is mark it out from the bottom of the wick to the top of the body. Once price closes underneath, we want to see continuation towards the downside. So that's what we have for the one in the middle. And then for the one on the right hand side, which is our lowest probability order block, we're going to have to draw it from the bottom of the body all the way to the top of the body. Price closes underneath, then we're going to be using this as a retest level for continuation towards the downside. What does this look like on a chart? In a downtrend, what we're going to be doing is looking for up close candles. So we can mark out this opening candle here from the wick to the body. Price closes underneath, and you can see price respects and continues lower. The next order block that we have drawn out is going to be this up close candle right here. So we can mark this out from the wick all the way to the top of the body. Since we have a very small wick, you can't even see it. I can barely see it. So we're going to draw out the whole body. You can see price respects it nicely and continues towards the downside. The next one, we have this up close candle. This one has a pretty big long wick. So we can mark out the bottom of the wick to the bottom of the body. You can see price closes underneath, retest, continuation towards the downside, and so on. And you can see exactly how this works. It's the exact same thing to the upside as the downside. And in the downside case, we're looking for up close candles to be supported for price to continue lower. So now with the basics of order blocks down, let's talk about the confluences, entries, stops, and targets when we're using order blocks in the one candle rule. So now let's talk about entries, stops, and targets. Of course, this chart is in hindsight. I already know what's going to happen, but we're going to talk about some examples here in a second that I did take in real time. So first things first, what we're going to do is mark out down close candles. So you can see our first candle, once we broke above, immediate retest, continuation higher. Another retest that we have, we can mark out from the top of the wick down in towards the body. You can see price respects, retest, and we have continuation higher. So let's say, for example, we're looking for an entry on this down close candle right here. Maybe you had some other confluence like your previous day highs, or maybe this was your 5-minute range candle here. So what we're going to do is draw out our one candle or order block in this case, which is our down close candle. Where we can have our entries placed is at the top of the order block. You can place it at the middle of the order block, or you can place it at the low of the order block. In my opinion, the best place to place your entry is going to be at the top of the order block and the middle of the order block, which is going to be at the body. Sometimes if you place at the body, it might not always get filled and price might continue higher. So the easiest way is to place it at the top of the order block. So this is where your entry is going to be. Your stop is going to be a break below the bottom of the order block, and then your targets, you're going to be looking for high of day plus continuation. In this case, it didn't offer you 1 to 2, so you're going to be looking for a 1 to 2 minimum for a continued push back towards the upside. So entries, stops at the low of the order block, and then the targets, you can be looking for a fixed 1 to 2, and you can see price ends up continuing towards the upside. This is the first entry that you could be looking for. So after this nice push towards the upside, where is our next down close candle? In this case, what we have marked out is going to be this down close candle. So we can mark out from the wick to the body, and we can drag it over. And you can see price actually comes back down to retest this down close candle. Why? It's because down close candles support price towards the upside. If we're looking for a potential re-entry or a second entry in this case, where can we have our entries? We can have our entries placed at the top of the order block. So this is our entry point. We can have our stops, as I mentioned, at the low of the order block. And then for our targets in this case, it's nice and easy. We're going to have it all the way back at high of day. So we have our entries, we have our stop, and we're looking for continuation back towards high of day and above. And this is our risk reward. This is the best order block in my opinion, just because it has a nice room for this continuation back towards highs. And in this case, you're looking for around a 1 to 3. And this is a very high probability trade in the right context, of course. The best order blocks are always going to occur when we are trading around key levels as well. A 1-minute order block or a 1-minute down close candle is not going to hold as much significance as something like a higher time frame order block or an order block that has multiple confluences. As for the entry, stops, and targets towards the downside, what we're going to do in this case is mark out up close candles, because now we're looking for a downtrend. So in this case, what we're going to draw, you can see price breaks towards the downside. We're going to mark out up close candles. So the up close candle in this case, we can draw it from the wick to the body and drag this over. You can see it's also in combination with our opening range low. So you can see price comes up, taps in towards our key level. If we wanted to look for entries in this case, what we can do is have an entry right at our order block low. Our stop is going to be at the top of the order block, and then we could be looking for low of day and below as our targets. So that's what we can have for our entry. You can see price continues lower, and then the next up close candle is going to be this right here. So this is a lower probability order block just because we have such a big range, as you can see. So let's say we're looking for a potential trade opportunity off this order block right here. Our entries would be at the bottom of the order block. So our entries would be right here. Our stop would have to be at the top of the order block, but you can see how big of a stop this would be, only looking for low of day. This is close to a 1-to-1 trade. In my opinion, isn't the greatest. So if we want a tighter stop, what we can do in this case, instead of risking at the top of the order block, we can risk off of your market structure, which is essentially is going to be this candle that took out liquidity. So if I remove this really quickly, we can have our entries at the low of the order block. We can have our stop, which we can make it a little bit tighter. And then we can be looking for low of day, which would be a 1 to 2 risk reward ratio. You can see trades would have ended up playing nicely back towards the downside. So with this being said, we have identified our up close and down close candles, and why in a downtrend, up close candles are going to support price lower, and why in an uptrend, down close candles are going to support price higher. So with this being said, I have a few key notes for you guys to remember. In an uptrend, price will respect down close candles. In a downtrend, price will respect up close candles. The best trades will occur around key levels, being your previous day highs and your previous day lows, plus your opening ranges. More confluence is the better. Of course, if we have an order block in combination with your opening range, or if we had an order block in combination with relative strength or a higher time frame level, those are always going to be the best order blocks to choose. Plus, what we have is unmitigated liquidity. Objective has not been met. So the best time to trade these down close and up close candles is when we have a clear objective that is to be met. If we're chopping around, that is a no-go. We do not want to be trading up close and down close candles when we're chopping, because there's no objective, there's no trend in the market. What we need is a trend to be able to trade. The best trades will occur when we're trending. If we're not trending, you want to be very cautious, because these up close candles won't support price, and these down close candles won't support price either. With this being said, let's now go on to some examples that I took in real time to help us solidify this concept. So as you can see, we're on my first example here. We're on AMD, and as you can see, just based off of its previous day key levels, just to give us a little bit more context, we are bullish because we are above your previous day highs. And now what we like to see coming to market open is really the hold of your previous day highs for potential continuation towards the upside. So let's mark out your previous day highs, and now let's go on to the lower time frames. Let's play with the tape. So as you can see right off the bat here on AMD, you can see we have really nice buyers stepping in off its previous day highs. This would have been a very aggressive entry. So in this case, after this really strong push towards the upside, what are we going to do? We're going to wait for the first pullback or any sort of down close candle, potentially opening range break. As you can see right here, what we have in this case is our first down close candle. This also happens to be our 5-minute range. So we have two things here. We have your 5-minute range. We also have a down close candle. So what we like to see now on AMD is the break above, retest. Now it's going to be of this down close candle and also your 5-minute range for continuation towards the upside. So let's mark this out. Let's play with the tape. So you can see right here for AMD, we broke above this down close candle. We're now coming back to retest this order block along with this 5-minute range here as well. What we want to do is wait for essentially the buyers to step in right off here. And as you can see, price tapped right into my down close candle, which was our 1-minute order block. We actually tapped into the body here. This is where I got in as this candle was developing. My stop was a break at the lows. And in this case, what was I targeting? I was targeting high of day plus continuation. In this case, high of day didn't make too much sense. So the next logical level that I had on the chart, we actually have to go back here on the daily time frame, which is going to be all the way back up and towards this key high, which is our 179.77. So this is the key level that I have marked out on the chart. And now we can play out the tape. And you can see right there on AMD, we ended up moving nicely straight up and towards that 179.77. As you can see, price respected our down close candle, which should support price towards the upside in an uptrend. We also held that 5-minute range perfectly. We actually tapped into it once more for that nice continued push towards the upside. You can see this is a great example. I actually ended up taking this trade in real time on AMD for this nice continued push, and we had some continuation as well. Now let's go on to the next example that I have. All right, the next example I have here is on Tesla. You can see so far, if we're looking at its previous day's price action, you can see we're in a clear downtrend here. Now coming into this morning, we're breaking underneath its previous day lows. What we like to see is it maintain underneath your previous day lows for this continued push down and towards your pre-market lows and below. So the levels we can have marked out is going to be this previous day low key pivot point. Now let's go on to the lower time frames. Let's play out the tape. So you can see right here on Tesla, we had that nice pop off the bat, but then we faded back towards the downside. So now we're really looking for one of two things. We're either looking for the retest off of your previous day lows for this continued push towards the downside, or we're now going to wait for the break underneath our 5-minute range low retest of this for continuation lower. Now let's play out the tape. All right, so in this case here on Tesla, we never quite ended up coming back up and towards our previous day lows. So now what we're going to have marked out is our 5-minute range along with this up close candle. So we can mark out this whole general area. This is now going to be used as a potential retest for continuation lower towards the downside, just because this is our 5-minute range plus our up close candles that should be supporting price towards the downside. All right, so you can see price is coming right back in towards our key level. This is where we can go look short. So my stop is going to be a break above this key level. And now what I'll be looking for is your pre-market lows and below. So now this can be our trade setup, and now we can play this out. And you can see right there on Tesla, we end up having a super nice reaction right off our key levels, which was our 5-minute range in combination with our up close candle. So you can see perfect entry with a very tight stop above. And then we're looking for key levels plus continuation. In this case, it was a 1 to 2. We are looking to scale all the way down and towards our next key levels, which was our 298 here as well. So this is a good example of using the up close candles, which is for the downtrend, along with our other key levels and confluences, which is our 5-minute range here. Now let's go on to the last example that I have for us today. All right, so we're on my last example here. We're on NVIDIA. Key levels we're going to have marked out previous day highs, previous day lows. We're inside of the range so far. So what we like to see for continuation higher, break above your previous day highs for continuation towards the upside. So this is the level I can have marked out here on NVIDIA. And now let's go on to the lower time frames. Let's play at the tape. All right, so as you can see here, we originally pushed lower, but then we had this nice continued push towards the upside. Now we are above your previous day highs. We also have a couple key levels marked out here as well, which is this nice down close candle in combination with your previous day highs. So what we like to see here on NVIDIA is now it maintain above your previous day highs along with this down close candle for continuation towards the upside. So you can see right here on Nvidia, we're coming right back down in towards this down close candle right here, along with our previous day highs key level. If we want to refine this level even more, we can mark out this down close candle, which is going to be at your 939. The reason why I'm marking this one out all the way down in towards the bottom of it is because this is the one that's most relevant. Plus, it's in combination with your previous day highs. So there's actually two confluences here. We have your previous day highs. We have this down close candle. You can see really strong reaction here. This is where I go long with a stop loss at the break below your previous day highs, along with this down close candle. And what I'm looking for now is a fixed 1 to 2 plus high of day for this continued push back towards the upside. Now we can play with the tape. And you can see right there on Nvidia, we end up having a super nice hold of that 1 minute order block. Nice continuation towards the upside. I actually came back down once more for another retest, and we end up having this nice continued push back towards the upside. So right there, as you can see, that was another great example of using the down close candle in combination with other confluences like the previous day highs and also the opening ranges. Now we'll be going over my full trading strategy. So I'll go over the basics of what my strategy entails. Then I'm going to go on to the 3 different setups that I use on a day-to-day basis, and then we're going to go over plenty of examples to show you guys exactly what this looks like in real time. Let's get into it. So now let's talk about the bare bones of my strategy, and what I personally trade is what's called the break and retest. So within the break and retest in itself, I have 3 primary setups. Number 1 being the opening range break and retest. This is one of my personal favorites. I have plenty of videos on this opening range break and retest. What we also have is the order block break and retest, and then we have the previous day high and previous day low retest. So these are the 3 primary setups that I used last month on a consistent basis. If I'm not using the opening range break and retest, I'm using some sort of order block to get in, or I'm using the previous day high and low break and retest. As I mentioned, all these setups are within the break and retest system in itself, so all the entry criteria are fairly similar. The difference between these setups is they're just at different key levels, but they all serve the same purpose. So really what we're going to be looking for in regards to the break and retest is we're just going to be looking for the price action around the key levels. So let's say, for example, this is your previous day highs. So what we want to see is the reaction that we have off of your previous day highs. If we can get above with displacement, what are we going to be looking for? The potential retest off of your previous day highs for this continuation back towards the upside. If the market wants to show some weakness, and let's say we get back underneath your previous day highs, we can be looking for the retest back towards the downside. So all we're doing is looking for the reaction around these key levels. This is basically what the strategy entails. Now let's go into the actual individual setups themselves and take a look at them a little bit more in depth. So the first setup that we have in this case is what's called your opening range break and retest. And basically how the opening range break and retest works is we're going to mark out the first candle high and low of New York session open. So at 9:30 a.m. Eastern Standard Time, this is when the New York session opens. What you want to do is mark out the first candle. So you can see this is the first candle of New York session open. This can be on the 1 minute time frame, this can be on the 5 minute time frame, on the 15-minute time frame, depending on what time frame that you trade on. This is going to be the first candle of New York session open. So we want to mark out the high and low of the first candle, and then what we want to do is wait for the break above or below the first opening candle. So in this case, what we have is this push towards the upside. So we have this nice push towards the upside here. Now what we like to see is the reaction off of your retest, which is going to be that opening candle range high. So what we like to see is the buyer step in off this opening range high to push price back up in towards, now it's going to be high of day and above. We also have another scenario that can play out on the opening range break and retest is if we actually get back underneath your opening candle range high, we can be looking for the retest off of this level for a push back towards the downside. In this case, it would be your opening candle range low and below as well. So this is actually a reversal setup. I use this quite often. If price doesn't want to continue in the general direction in which it broke out of, you can be looking for the reversal trade to target the opening candle range low. So this is a setup that I'll use if I'm expecting some sort of potential fake out on the markets, or if we're looking for an intraday reversal on a higher time frame trend. In both these setups, when we are looking at risk to reward, is going to be fairly tight. If we're looking for a push back towards the upside, our risk is going to be very minimal. We're just going to be risking underneath this candle low, looking for this push back towards the upside. And similar to the downside, downside, if we end up having this retest back towards the downside, our stop is going to be fairly tight and we're going to be looking for this reward back in towards your opening candle range low and below. And that's why the break and retest works so well, is because we can have minimal risk and we can look for the high reward. So we don't need a super high win rate in order to become profitable. We just need to be right enough and have a solid risk reward ratio in order to capture these trades on a consistent basis. So the next setup that we have here is your previous day highs and your previous day lows break and retest. And all we want to see is the reaction that we have off of your highs and lows in the markets. If we can bounce off of your previous day lows, we could be looking for a pushback up and towards your previous day highs. If we reject off your previous day highs, we can be looking for a pushback down in towards your previous day low. And similarly, if we can break above your previous day highs, we can be looking for the retest for continuation towards the upside. If we break underneath your previous day lows, we could be looking for a continued push towards the downside. And this is one of the best setups that you can use in combination with other setups as well, with other confluences, because these daily highs and lows are the strongest levels that you can see on a chart. So these levels are not only intraday levels, they're also higher time frame key levels as well, being daily levels. So that's why these levels are the most high probability levels that you can be looking to take trades off of. When it comes to risk or reward when you're trading the previous day highs and lows, as I mentioned earlier, a lot of it is very much low risk. So if you're looking for potential pushback up and towards your previous day highs, right, and you're looking to trade off of your previous day lows, your stop's going to be right underneath, right? And then of course you're going to be taking partial targets along the ways. You're not always going to be holding for a push up and towards your previous day highs. If you're looking for a potential short position off of your previous day highs for a push down in towards your previous day lows, this is what your risk to reward ratio would look like. If you're looking for potential continuation underneath your previous day highs and lows, then you'll be looking for the low risk just to break above, and you'll be looking for this continued push down in towards the next external level that we have on the charts. So now let's go on to the final setup that I personally use. And the final setup that I have in this case is what's called your order block. So in a downtrend, what we want to be doing is looking for up close candles to be used as resistance. In an uptrend, we want to be using down close candles as support. So what we can see right here is that we have a clear downtrend in the overall markets. And as you can see, what we have is an up close candle. So if you have an up close candle in a downtrend, what we now want to see is this level be used as resistance for continuation back towards the downside. So what we want to have marked out for your highest probability order block is the wick to the body. This is going to be your highest probability order block, and you would like to see price reject off this area. If you want a more in-depth guide on how to draw order blocks, I have plenty of videos going over what order blocks are, but what we want to be looking for in this case is the reaction off your up close candle, and we're going to be looking for continuation towards the downside. So if we are looking for a trading opportunity and we're looking for potential entry point off this order block, what we can be looking for is our entry right off our order block with a stop just to break above, and then we're going to be looking for our targets, which is going to be continuation towards low of day below. So this is our reward, and then this is our risk as well. And then plus we could be looking for potential continuation underneath your low of day and potentially below as well. So with this being said, this is the final setup that I personally use within the break and retest system. These are the three primary setups that I use on a day-to-day basis. Now let's go on to some examples to show you guys exactly what this looks like in real time. And then I'm going to be showing you guys the live trading sessions as well. So as you can see right here, I'm on Tesla. This is my first example. This was on March the 4th. This was actually the first trade that I took of the month. Ended up being a super solid trade. Ended up making around $12,000 on this name. I ended up trading 30 contracts, which is more than I normally do. In this case, I actually added into my position, which is not something I usually do. The reason why I added into my position was because of the higher time frames, and it was such a good setup as well, respecting the higher time frame key levels along with showing relative weakness intraday. I ended up making 60% on the contracts, but as I always mention, what matters in this case is not the actual dollar amount, it's how much I risked. So in this case, I was risking around $1,800 on this contract, so it ended up being a 6.75R multiple. So this means if you were to risk $1,000, you would make $6,000, and if you were risking $1,800 in my case, you would end up making over $12,000. And for the setups that I end up taking, this was a previous day low retest along with a opening range break and retest on the 1 minute time frame. So let's go on to the charts to see exactly what this looks like. So as you can see, coming into this day here on Tesla, we're underneath its previous day lows. So you can see we have a big push towards the downside on its previous day, and in the pre-market, we actually break underneath its previous day lows. So coming into this morning, what we're going to be looking for is the retest off of your previous day lows for this continued push back towards the downside. And you can see right here, we have that perfect rejection off of your previous day lows. This is where you could have been looking for that low risk entry. And then there's also another setup on the intraday time frame on the 1 minute time frame as well. So now we can mark out your previous day lows and go on to the lower time frames. So now you can see we're on the lower time frames. The key levels I have marked out coming into this day was your opening range high. You can also mark out your opening range low as well. You can see price pushes up. We're breaking above your opening range, but we're not going to be looking for a long position in this case because your previous day lows is right above. So it wouldn't make too much sense to long right in towards your previous day's low. So what we much rather do is wait for the reaction off of your previous day lows, and you can actually potentially short this back towards the downside because the higher time frames is leaning bearish. So in this case, what we can be looking for is the potential rejection off of your previous day lows. You can see in this case, right, this would be your really aggressive entry. What I was waiting for was the break back underneath your opening candle range. So in this case, I actually ended up taking a starter position once price was breaking underneath your opening candle range high on the 1 minute time frame. And then you can actually see we end up coming back to retest this opening range candle high once again, end up having a super solid reaction off this level. We end up forming our 3-bar pattern towards the downside as well. This is where I actually added into my position, and then we end up having this nice continuation lower. Now we broke underneath your opening candle range low. We end up using this as a retest, and then we end up having this super solid follow through back towards the downside. So you can see exactly how I was able to use your previous day low retest in combination with your 1 minute opening range breaking retest as well. If you're strictly just a pattern trader, a lot of people would be looking for this long position towards the upside. But if you zoom out just a little bit, right, if you go into the 5-minute time frame, you can see exactly why this was such a great trading opportunity. So instead of looking for that opening range break and retest on the 1 minute time frame towards the upside, you'd much rather look for your previous day low break and retest towards the downside. Now let's go on to the live session that I have for this day. Coming into market open is going to be Tesla. It does seem like it's dropping here in the pre-market. This one does have a daily gap towards the downside. So for Tesla, as you can see right here, the key level that we have marked out is our 275. We have this daily gap all the way back down towards 255. What I like to see is really the retest off of your 275, which coincides with basically your previous day lows and your Friday's lows as well for a continuation lower. So you can see right here on Tesla, the game plan is fairly clear. We have a huge gap towards the downside, but what we're looking for is the fade off of your Friday's lows, which is also coincide with your previous day lows as well for this potential continued pushback towards the downside here on Tesla. Yeah, so far SPY's retesting your previous day lows as well. Not sure what my trading view chart's on, but yeah, Tesla here, watch out for the 265s. If you can have a weak candle closure, we can use basically your 275, 62 as risk now. If we have a weak candle closure underneath this 274. Yeah, all right. I got some of the Tesla, the 265s on Tesla. My risk in this case is going to be this 276. I will look to add on most pops here. So rejected off of its previous day lows. And now with the Qs dropping here as well, I do expect Tesla to head down towards its opening candle range low and then potentially lower on this name. I got the 265s on Tesla. So as you can see right here, I just entered into a position here on Tesla, which is the 265 puts. What I was looking for was this push and break back underneath your opening candle range. With the Qs dropping here as well, I like to see continuation lower. Tesla now I like to see it just maintain underneath this 273 for a continued push towards the downside. The reason why I got a more aggressive entry instead of waiting for the retest was because the higher time frame was bearish. It rejected off of your previous day's low. The Qs were showing weakness as well. I didn't want to miss out on this huge trading opportunity because there was a big gap towards the downside, and I was going to be looking to add on all pops as well, risking off that 275. Q's flushing here as well and back underneath this 490. If we get a weak candle closure, this can move quick down towards 265. Contracts around $9 a con now. So you can see Tesla pushing down nicely after rejecting off your 274 once again. I end up adding into my position. Risk is just a break above this 275. And now what I like to see is continuation underneath your opening candle range low for this pushback towards the downside. So far, sellers are stepping in on the Qs and Tesla, but we still have to make a fresh low on the Qs if we're going to have that continuation lower. Yeah, there's that 10 o'clock too. See, look at the time. All right, nice push lower here on the Qs, right at 10 o'clock as well. Tesla coming down towards this 265 is a key area. Contracts now. Make sure to scale here with the Qs flush now. Super solid. Yeah, so you can see super solid trade here coming into 10 o'clock. Tesla rejecting off now your opening candle range low along with this 1 minute order block. Qs getting underneath this 493.60, pushing down towards the downside as well. So this ended up being a super solid trade here on Tesla. So I sold majority of my position on Tesla down in towards this 264.96. I cut the rest of my my position once it broke back above this 267. Now let's go on to the next example that I have for us today. So I'm on my second example here, which is on Tesla, Wednesday, March the 26th. I actually ended up taking two trades on this day. One was on Nvidia towards the downside, and then I also took Tesla along as well. This ended up being a $7,800 win. As you'll see, my position size has increased this year just due to the volatility and liquidity in the markets. 2024, there wasn't too much liquidity intraday. It was just a lot of higher time frame setups with swings, and price was just pushing towards the upside. But now with this volatility and liquidity in the markets, you can be looking for a lot more setups intraday. And since there's so much liquidity, you can put on more size because these option contracts are more liquid. As I mentioned, what matters is not the actual dollar amount, it's the amount that you risk. So in this case, I risked around $2,000 on this trade, which ended up being a 3.73 risk to reward. The setups that I ended up taking in this case was your opening range break and retest on the 5-minute time frame. You can see these are the executions for the 280 contracts that I end up trading. And as you can see, this perfectly lines up with what is shown here as well. Now let's hop onto the charts to see exactly what I was looking for. So as you can see here on Tesla, what I have marked out will be your key levels. In this case, this was your key pivot level from earlier into the day. It technically was not your previous day highs. Your previous day highs was all the way back here, but you can see reaction at your key pivot point. We had another reaction later into the day. Once we got above this level, we ended up having this nice push towards the upside, but then it ended up just opening up right around your pivot point from its previous day. So this is going to be a very key level coming into market open here on Tesla. So we can have this marked out. Now coming into market open, what are we going to be doing is looking for the reaction that we have off of your 283. If we can get above your 283, we can see potential continuation back up and towards it's going to be your previous day close. If we reject off your 283, we can see this push back down in towards your previous day lows, which is all the way down towards your 272. Now let's go on to the lower time frames. As you can see here, now we're on the lower time frames. We have our key pivot point drawn out, which is our 283. You can see right off the bat, we can also mark out your opening range candle, which is basically your opening range high. We can also mark out our opening range low here as well. In this case, for your opening range low on the 1-minute time frame, we really didn't have too much reaction off of your opening range on the 1-minute time frame. So what I had marked out in this day was actually your opening range on the 5-minute. So I had your 283 marked out. I also had your opening range low marked out as well. You can see price tries pushing towards the upside towards your 283. We're unable to get above your 283. We end up pushing lower with displacement underneath now your low of day. Also your 5-minute opening range low as well. Price comes back up to retest this level perfectly. This is exactly where I get in, which is offer 280. My risk just to break above, and I was looking for continuation towards the downside. You can see how well this ended up playing out right off of your opening range on the 5-minute. We ended up having weak price action around this key level as well for this continuation lower. So now let's go on to the live session to see exactly how I executed this trade in real time. Keep an eye out on coming to market open. Tesla's going to be the main one. We're going to keep an eye out now. Basically, it's going to be Nvidia, previous day lows, Tesla, if we can hold above and really reclaim this 285 coming to market open, and then we'll also keep an eye out on AMD as well. So yeah, coming into today, as I mentioned, my watches, we're going to keep an eye out on Tesla, the reaction off of your 284, and then Nvidia, we're going to keep an eye out on your previous day lows, which is your 119. Yeah, so we'll see what happens. We have about a minute here until 10 o'clock as well. Basically, the markets, after that initial pop on SPY, kind of faded off towards the downside. Now we're just going to mark out up close candles if we're going to be looking for potential continuation lower. Tesla, the key level is going to be this basically 5-minute low, 280 if it can come back up into that. And then Nvidia is coming back up. The key level now is going to be this 1-minute order block. So you can see we have the tape played out for the first 30 minutes. You can see Tesla rejecting off your key pivot point. You can see the Qs are showing some relative weakness here as well. I personally didn't take any trades within the first 30 minutes. So now what I'll be looking for is the retest on Tesla, potentially off your 280. For Nvidia, it's going to be this 1-minute order block retest. And now we're going to be looking for the retest for this continued push down on the overall market with the QQQ weakness as well. Yeah, let's keep an eye on Tesla here. This one, previous day lows, sorry, your 5-minute opening range, up close candle as well, your 280.43. All right, I got some 280 puts here on Tesla. Risk is just going to be a break above this 280.70. So if the market wants to stay heavy here, that's great. Risk fairly tight, just going to be a break above this candle. And then I'd like to see some continuation lower on the overall markets. So as you can see right here, I just entered into some of the 280 puts here on Tesla. I really like this setup. So I kind of got in before this candle closed. So it's a little bit more of an aggressive entry, but my risk in this case was fairly clear, just to break above this 281 key pivot level. For the QQQ, I like to see it stay heavy underneath this 490. And then for Nvidia, I like to see it hold underneath this 1-minute order block. Nvidia looks good as well. Risk would just be a break above that 117. Yeah, the Nvidia, I know actually taking some Nvidias as well, off that 116 risk. So I ended up taking some NVIDIA contracts as well off this 1 minute order block. My risk in this case was just a break above, a little bit of a later entry, but I really like the setup as well with the Qs rejecting off of your 490 along with Tesla rejecting off your 280 as well. So yeah, Qs, a little bit of reaction here around low of day, but that's basically what we wanted here. Now for the Qs, if we can get some more continuation lower, right, that'd be perfect. NVIDIA's gonna drop, Tesla's gonna drop. If Qs ends up reversing here, then these ones are more relatively weak, so they could technically still stay heavy. Yeah, Tesla scale along the way is 275. Next level for Tesla, basically the level that we just hit, and then all the way down towards that 274. You can see the relative weakness compared to the Qs. So now, right, let's say Tesla, potentially you can see 274 if the Qs drops, but this is your key level 274. Make sure it takes them off here on Tesla. So yeah, super solid continuation towards the downside on NVIDIA and Tesla. You can see Tesla made a new low of day while the Qs is technically defending your low of day. So that just means that Tesla is relatively weak, and we should see some more continuation towards the downside if the Qs can potentially break underneath this 489 as well. Similar to NVIDIA, this one, I like to see that push down in towards that 115. But yeah, as you can see right there, super solid push on the Qs underneath this 489. NVIDIA hit my main target, end up selling my full position down towards that 115. Tesla end up selling majority of my position down in towards this 273. So this ended up being a super solid day in the markets. Took the 5-minute opening range retest on Tesla, order block retest on NVIDIA with the overall Qs weakness in the market as well, which ended up being super solid. So now let's go on to the last example that I have for us today. So now you can see we're on my final trade example. This is on NVIDIA Friday, March the 28th. This ended up being a $3,000 day. End up trading 60 contracts on this name for a net ROI of 60%. This was on a Friday, so the 0 days. That's also why I was sized down here as well. I was risking around 70 cents on the contracts, and my risk being around $1,000, and my R multiple in this case was a 2.84 risk to reward ratio. For the setups in this case, it was an opening range break on the 1-minute time frame. Now let's go on to the charts to see exactly what I was looking for. So the key levels that we have marked out coming into March the 28th is going to be your previous day lows. We also have your previous day highs marked out. So you can see we have a big push down on this day. Day number 2, we consolidate. So day number 3, what are we expecting? We're expecting continuation towards the downside if price can stay heavy. So in this case, the key levels we have marked out is going to be your previous day lows. We're also going to mark out our intraday key pivot points as well. And we're going to be looking for continuation towards the downside just based off of day 1 here on NVIDIA. Now let's mark out our key levels. So our key levels in this case can be your previous day lows. And now we can go into lower time frames to mark out intraday levels. So you can see right here, coming into market open, the key levels that we have marked out is now going to be your opening candle range high. So you can see right here, coming into this day, what a lot of traders will do is strictly just be pattern traders. They'll mark out their opening range, wait for a break, retest, and then they'll look for continuation, right? They'll have a nice entry point, as you can see right here. What they'll do is have their stop just a break below, and then they'll have their targets being high day and above, and they can see they'll instantly get stopped out. The reason being is because they're not looking at the higher time frames and they're not thinking with context and logic. If you zoom out just a little bit, you can see prices rejecting off of your pre-market highs. We're well underneath your previous day highs. We're actually coming back to reject off of what? It's your day 1 lows. So this is technically not a previous day low retest, but it's a retest off of your low that we created on March the 26th. So this level right here, which is your low, is now being used as potential resistance for continuation towards the downside. So this is a very similar setup to what we saw before, which was the reject off of your day 1 lows. So now you can see this makes a lot more sense on why it would be very difficult to look long. So you can see that price just came up in towards your March 26 lows, rejected off that level, came back down with a very strong reaction, created that lower high, broke back underneath your opening candle range on the 1-minute time frame. And you can see price is now showing weakness. Got back underneath, retest once again. Coming into 10 o'clock, I was very much bearish on this name, stopped just to break above, and now I'm looking for a continuation towards the downside to target your low of day, your previous low of day, and below as well. So this ended up being a super solid trade towards the downside using the opening range break and retest. And hopefully you guys are understanding the logic and context behind what I'm explaining. Of course, I'm explaining this in hindsight, but I'm showing you guys the real trades and the thesis behind why I took the trades in in real time as well. And really, this is the important stuff, and not just understanding the pattern, but understanding the context and logic behind the patterns and why the trades actually work and the reason why price moves. So now let's hop onto the live session that I have for this day. As for Nvidia, this one, I still am interested in this one and the pop and fade off of your 113. So we can keep an eye out on this one. So you can see right there, what I'm looking for is fairly clear coming into today on Nvidia. I'm looking for the pop and fade off 113. If we can stay heavy underneath 113, we can see some more continuation towards the downside. The reason being is because we had a very big push towards the downside. We started consolidating, and now we'd like to see continuation lower on day number 3 towards the downside. The 5-minute setup on Nvidia looks solid for a continuation lower. So far, it's kind of rejecting off this Wednesday's low, and I can see a nice little reaction. What I like to see on Nvidia really is this push back down towards low day and potentially your previous day lows. This one is going to have to stay heavy, so it's going to have to break, hold underneath this level now, which is now going to be this opening range. You like to see Nvidia hold this level for a continuation lower. Now, what I like to see is Nvidia stay heavy underneath your 1-minute opening range. After rejecting off your Wednesday's lows, I like to see it stay heavy, and then I like to see some continued push towards the downside. Yeah, I just picked up some of the 111s here on Nvidia. I'm on lighter size since I don't have the greatest entry, but I have some 111 puts. My risk is going to be a break above this 111.80. So as you can see, I just entered into the 111 puts. I'm on lighter size because it is Friday. Risk is just going to be a break above this 111.80. And now I'm looking for this continued push towards the downside. Qs, I like to see it stay heavy underneath this 478 for this continued push towards the downside as well. Yeah, nice push lower. Make sure to take some off Qs. Nice drop here. Next level Nvidia all the way down towards this 109. Tesla previous day low basically just hit. Sorry, low of day. Next level 267. You can see SPY. Nice reaction off this 564. QQQ next level. We have lots of more room lower actually on the Qs. So as you can see now, Qs starting to push towards the downside underneath this 478. Nvidia, I like to see now just this hold underneath this 110, but super nice push. Now we're looking for continuation down towards that next key level. Yeah, closed full position here on Nvidia, still holding a couple Teslas. So you can see Nvidia end up selling my full position down in towards this 109, end up being a super solid trade with Q staying heavy as well, down in towards that 472. Finally, what we have is how to identify and how to enter in high probability trades. Entering trades is very important, and understanding the 3 different entry models that we use on a day-to-day basis is key getting those low risk, high reward trades. So of course, we're going to go over exactly how to enter trades, and of course we're going to go over examples as well. So what we have here on the left hand side is we have a nice uptrend in the market where we're making higher highs, higher lows, and we're continuing towards the upside. So if we're in a very clear uptrend in the market, what do we want to see? We essentially want to see this previous resistance now turn into support for this continued push towards the upside. So when we're looking for this retest opportunity, there's really only 2 scenarios that can play out. We either have that continued push back up and towards high of day and above, or we get that break below and we ultimately fail and continue back towards the downside. So how are we going to be able to determine if we're going to fail and break back towards the downside, or if price is ultimately going to have a nice retest and we're going to have continuation back towards the upside? So this is exactly what we're going to talk about in today's video, is how to identify high probability entries, the different type of entry criteria that we look for, all the way from being aggressive to the most conservative. And then we're going to go over the pros and cons of each entry confirmation. And then of course, we're going to go over examples at the end of the video. So let's talk about now the 3 different types of entries. So the 3 different types of entries that we're going to talk about today is number 1, the limit order, which is the most aggressive when it comes to trading. That means you're going to get in every single time because you have a limit order set. The second one is strong price action. It's a more conservative entry model. You're observing price action and you're waiting for the buyers to step in. And number 3 is my personal favorite. It's strong price action plus confirmation. And this is the most conservative entry model, which gives us the highest win rate in the most highest probability setup. So now let's talk about the entry confirmation number 1, the limit order. So the first entry confirmation that we have is our limit order. And the limit order is very self-explanatory. All we're going to do is have a limit order set right at our key resistance, now turn into support level. So this is where we're going to have our limit buys, and we're going to have this set right here with a predetermined stop, which stop in this case is going to be the break of structure, which is all the way down in towards this higher low key pivot point. And as for our targets, we're going to be looking in this case for a fixed 1 to 2 back towards the upside. So as you can see right here, this is where our target is. Our stop is going to be all the way back down at our break of structure level. And now we're just going to be waiting for price to hit hit our limit buy. So you don't have to do anything once you have your order set up. So as you can see, I have an example pulled up, and what I'm going to use in this case is our limit order. So as you can see, we have a clear level of resistance now turning into potential support. All I'm going to do here is have a limit order set. So I'm going to have a limit order set right around our previous break and retest level. I'm going to have a stop at our break of structure point, and my target's already predetermined at a 1-to-2 risk to reward ratio. So when it comes to this entry model, regardless of the price action, as I mentioned, we're going to be getting into the trade no matter what. And let's see how it plays out. As you can see right here, it ends up playing very nicely. We end up having this perfect retest with displacement here, clear stop. We end up having a super nice reaction off of our retest level again. And then we end up having this continued push back towards the upside for a nice 1-to-2 risk to reward ratio. So this is the limit order. It's very nice because now we're getting a super nice entry. We had very minimal drawdown and we end up having this continued push towards the upside. So this is an example of the limit order working out. Now let's go into another example. So we have another break and retest pulled up here. And what we'd like to see once again is this area of resistance now be used as potential support. Once again, we have our limit orders already set. We have our stop predetermined and we have our target set in this case as a 2-to-1 fixed risk to reward ratio. So no matter what happens off this key level, we're going to be tagged in and we're going to have our stop and targets already set. And what happens in this case, you can see that during this time, price ultimately ends up coming back into a retest level. No real reaction, but since we have a limit order, we're going to be getting into the position. And now you can see price gravitates down towards our stop fairly quickly and we end up getting stopped out. So as you can see right here, both these were a good example of the limit order in effect. It doesn't matter the context or the price action around the key levels. If you have a limit order or if you have a bracket order set up, you're going to essentially be getting into every single break and retest possible. And now let me tell you the pros and cons on why you should not use the limit order entry. So as you can see right here, what we have in this case is the pros and the cons for the limit order. One of the pros that we have when it comes to the limit order is we get in every time. So we get in every single time, no matter if it's a good or if it's a bad break and retest. This can actually be a pro or it can actually be a con as well. Second, what we have is the best entry. So we get filled on the limit. So that means every single time when price does come down, we're going to get the best entry possible. It also coincides with our third pro, which is getting filled on the bid. So whenever you have a limit order, instead of buying on the ask, you're buying on the bid. So you have a limit order set there. So you're going to get the best fills possible. And then finally, what we have in this case is your highest risk to reward towards high of day. So every single time we get into a break and retest, if we get in that limit order, we're going to have the best entry possible. We're also going to get filled on the bid and we're going to have the highest risk to reward towards high of day. So these are all the pros that we have for the limit order. As for our cons, and the cons in this case is it has the lowest win rate. The reason being is because no matter what break and retest you're getting into, it doesn't matter if it's a high probability or if it's a low probability break and retest, you're going to be getting into that break and retest no matter what, especially if you're looking for high of day plus continuation. So you have around a 30 to 40% win rate depending on the market conditions. Another con is that you are prone to fake outs. So a lot of times whenever you get into any sort of break and retest, a lot of times it can be a fake out. And this also ties into all the other ones above, which is taking unnecessary losses. So whenever you get into every single break and retest possible, a lot of these break and retests can be avoidable if you observe the price action around the key levels. So with this being said, you can see that we have the pros and cons figured out for the limit order. Now let's go on to the second entry model, which is our conservative entry model. So as you can see right here, what we have is our conservative entry model. And now what we're doing is waiting for strong price action. So as you can see, we're still in a clear uptrend, making higher highs, higher lows in the markets. What we like to see now is the reaction that we have off of our previous resistance now turning into support. In this case, what we can do is observe the price action around the key levels and wait for what's called strong price action. So as you can see, once we get that break, now we're coming back for the retest. What we like to see now is the reaction that we have off of your retest level. So in this case, you can see that the buyers are stepping in. What we can do is wait for the candles to close. So once we clearly see these bottom wicks are being formed, we can now look to take an entry after the candle has closed. Our entry point can be on this candle closure. Our stop can be a break underneath this candle low. So instead of risking off this market structure low, we can risk off this candle low, have our stop just a break below. And as for our targets, we can be looking for high 5-day or 1 to 2. In this case, we're just going to target a fixed 1 to 2 just to make it very easy. So we have our targets, entry, stop, and now what we like to see is that continue push back towards upside based off of observing the price action that we have off of our key levels. Now let's go on to what this looks like. So as you can see right here, what we have is a clear level of support. Now we're breaking underneath here with displacement. What we like to see is the reaction that we have off of your retest level. So we can have this level marked out. You can see price pushes towards the upside. So far, we're respecting the bodies of our up close candles. We now are observing the price action. You can also see the next candle is a weak candle. So it's a red candle in this case, signifying that sellers are stepping in. Now you can do is look for an entry with a stop, just a break above, and we can have our targets all the way down in towards low of day and below, being a fixed 1 to 2 risk to reward ratio. As you can see, the trade ends up working nicely. We end up having this nice candle as well, confirming that price was most likely going to head towards the downside. And then we get that confirmation that price does indeed head down in towards low of day and below. So this is a great example of observing the price action around the key levels and waiting for the sellers to step in. Now let's go on to another example. So another example we have in this case is a break and retest towards upside. We have our 5-minute range marked out here. As you can see, we are breaking towards the highs. What we like to see now is the retest that we have off our key level. You can now see the buyers are stepping off this first candle. We have more buyers are stepping in, clear signs that price does want to gravitate back towards the upside. So you can see clearly by observing the price action here with these lower wicks that this name does want to move back towards the upside. We wait for this nice candle close here. This can be our entry point with a stop just to break below, and our targets we can be looking for high of day and above. So let's see how this trade ends up playing out. So as you can see, this trade ended up playing very nicely with the buyers stepping in off our retest level. You can see we end up having a very nice reaction and continuing towards the upside. So with this being said, now let's talk about some of the pros and cons that we have for the conservative entry model. So when we're looking at the pros and cons for our second entry model, pro number one is that we wait for the buyers to step in. So instead of buying in every single break and retest, we're observing the price action and waiting for the buyers to step in off our key levels. Second, what we have is risk is close below swing low. So the most recent swing low that we created, we can risk off that hammer stick candle preferably instead of risking off that market structure low. So our risk will be a lot tighter in comparison to the first entry model. Pro number two, risk to reward is still good towards high of day. Once you wait for the buyers to step in, it is very similar to that limit order entry. It's just waiting for one extra candle. So in this case, the risk to reward will still be good towards high of day. And then the fourth pro is you can get in majority of the time. So when you wait for the buyers to step in off your key levels, a lot of the times the risk to reward is still good, and then you can get in majority of the times before it gravitates towards high of day. As for cons, some of the cons that we do have in this case is it's a medium win rate around a 50%. Depending on the market conditions, it could be a little bit lower. What we do have is a 50% win rate with medium risk to reward. I wouldn't really consider this a con. Second one is we're still prone to fake outs, so we're not waiting for clear confirmation that price does want to happen. Sometimes the buyers do step in, but then ultimately end up failing and breaking towards the downside. Number three, taking unnecessary losses. So a lot of times what happens is that you think the buyers are stepping in, so you'll end up entering positions even though the retest isn't as clear. And that kind of ties into my last point, which is more discretionary. So when you add in discretion into your trading, it makes it a little bit more difficult because now you're basing it off of experience. And especially if you're a beginner, you do not want discretion in your trading. When you're more experienced, you know what the buyers look like when they are stepping in. You can read the tape, read the momentum of how fast the candles form. This is very good if you have experience and you know what you're doing. But when you are a beginner, more discretion does not mean it's a good thing, especially when you don't know what you're doing. With this being said, we went over the pros and cons and exactly what the second entry model looks like. Now let's talk about the third entry model, which is the most conservative. So as you can see now, what we have is the last and final, which is my personal favorite. It's waiting for strong price action plus confirmation. So as you can see in this case, what we have is still this clear uptrend on the overall markets, making higher lows, higher highs, and we're continuing to push towards the upside. So what I like to see in this case now for the overall market is the retest and the reaction that we have off of your previous resistance level. You can see that the buyers are stepping in. So this is the strong price action. And now this is the added step, which is plus the confirmation. So as you can see right here, the buyers are stepping in, and now we have that candle close above its previous candle. This is when the buyers are now really in control. When we get that confirmation candle, which means now the current candle is closing above its previous candle. So this is a very bullish sign that price does want to gravitate back towards upside. And in this case, our entry is going to be on this candle close or as the candle is breaking above. There's two different ways you can enter in this, but to make it nice and easy, we're going to wait for this candle to close with an entry. As for our stops can be very tight. In this case, our stop can be a break below its previous candle. So in this case, break below our previous candle. And as for our targets, we can be looking for a fix 1 to 2 back towards the upside. So this is my personal favorite, is waiting for the strong price action plus the confirmation candle. This is the most conservative entry model. But now let's go on to what this looks like here on the charts. So as you can see here on this name, what we have is a clear push towards the upside. What we have formed is your 5-minute range. We also have this down close candle here as well. What we're now really waiting for as price pushes into our key retest level is the strong price action, number one, and then we're waiting for confirmation that price wants to gravitate back towards upside. So you can see price pushes down in towards that retest level. Now we're consolidating in this general area, and now you can see price has a nice candle close above with a stop just a break below, and now we're looking for high of day plus continuation back towards the upside. So you can see this chart end up playing out nicely right off our key 5-minute opening range along with our 1-minute order block. And once we got that confirmation candle, we had a very tight stop, as I mentioned, break underneath, and we're looking for a continuation back towards the upside. Now let's go on to another example. Another example here is an immediate retest. So in this case, you can see this is our 1-minute opening range. Of course, this doesn't look like much without context. I'll show you this trade with context here in a second. What we have is the break above your 1-minute range along with the key level here as well. Buyers are stepping in based off this lower wick, but what we're doing is waiting for a strong confirmation candle. As you can see in this case, this candle right here closed below its previous candles. We could be looking for an entry with a stop just to break below, and our targets we can be looking for continuation and above. Now let's see what this looks like. You can see as soon as we got that confirmation candle, we end up having this really nice continuation back up and towards high of day and above. So as you can see right here, this is the third and final entry confirmation, which is waiting for strong price action plus confirmation. So now let's go on to the pros and cons of the third entry model. So the pros and cons of the third entry model. The pro here is that it does have the highest win rate possible. So when you're observing price action and you're also waiting for confirmation as well, you're going to have around a 60 to 70% win rate because you're waiting for that extra confirmation. This, of course, right, is around 60%, 70% to 80% in a more bullish market. In this case, what we have is risk off or swing low. So instead of risking at your break of structure level or risking underneath that break and retest level, we have a very tight stop, which is really risking off the previous candle that we formed. So very minimal risk here. Another pro that we have is you're in the trade for the shortest period of time. So sometimes the break and retest occurs and it happens right away. Sometimes you'll be in a break and retest and you'll just sit in consolidation. So whenever you wait for the buyers to step in and wait for the confirmation, right, you're waiting for that confirmation candle. And whenever you get that confirmation, majority of the times we're going to start gravitating back towards high of day because that's what confirmation's for. And then another pro is you rarely get any fake out. So if you do get faked out quite often, you can wait for that confirmation candle and there's a very good chance that price is going to gravitate towards high of day and above. As for some of the cons that we do have, lowest risk to reward towards high of day. So if you do like to scale some off at high of day, this might not be the entry model for you because majority of the times when you're waiting for that confirmation, we are fairly close to high of day. Another con is sometimes you miss the trade. So if you do wait for confirmation, sometimes price is already at high of day when the candles do close. So sometimes you might miss out on some good trading opportunities. Another con is buying after a bullish candle. Some people don't like doing this, especially for trading options, is you're buying the ask instead of buying the bid. And whenever you buy after a big green candle, usually that's when the premiums pop. So you're not really getting in the best entry. And finally, what we have is getting filled on the ask. And when you get filled on the ask after a big bullish candle, usually you don't get the greatest entry possible. So that sometimes can be a con, especially if you're trading options. So with this being said, we went over the pros and cons for all three different entry criteria. Now let's have a quick recap. So for the checklist on exactly what we're looking for when using these entry confirmation is number one, we want to make sure that we are trading around key levels. The entry models don't matter unless we are at key levels in the markets, being your previous day highs and lows, your opening ranges, order blocks. If we're trading in the middle of the ranges, these entry confirmations aren't going to matter and we can get faked out plenty of times. Next, what we're going to do is observe the price action. This is something we always want to do, and this is something that we use on the last two entry models. Of course, we don't wait for a price action to develop on the first entry model. I'll talk about some criteria here on when we should be aggressive and when we should be laid back. And finally, what we have is candlestick closure. So we always want to be waiting for those candles to close. As I always mention, right, wicks do the damage, bodies tell the story. So with this being said, when should we be more aggressive? Majority of the times we should always be looking for entry confirmation number 2 and 3, which is waiting for price action plus confirmation. But when should we use the more aggressive limit order? The times when we should use the more aggressive limit order is number 1, a clear higher time frame setup. If we have a very clear bias to one side, we can be a little bit more aggressive in the overall market. Another scenario is when we have an A plus setup forming, which also includes higher time frame setups plus news. And then finally, what we have is the downside. So I usually like to be a little bit more aggressive on the downside because a lot of the times what we have is stair step up, elevator down. So if we aren't as aggressive on the downside, then the majority of the times we're going to miss the move. Whereas if we trade towards the upside, we usually wait for the buyers to step in. We could also wait for confirmation as well. When not to use the more aggressive entry model is when there's not a clear higher time frame setup. So majority of the times we do want to be more patient and wait for that extra confirmation. Another scenario is when we're trading inside of a range / no trend. This happens when we're in consolidation on the higher time frames and there's a lot of chop. And then finally, when there is no displacement. When there's no displacement on a chart, we want to be very selective and we want to wait for extra confirmation because we don't want to get faked out. So with this being said, now we went over all the entry confirmations, the pros and cons, when we should be aggressive, when we should wait for confirmation. Now let's go over some examples to see what this looks like in real time. All right, so as you can see, we're on my first example here. We're on NVIDIA. We're on the 15-minute time frame currently. And as you can see, what we have here coming into market open is this double top here on the higher time frames. So far, you can see we're gapping up in the overnight session and in the pre-market here as well. What I'd like to see coming to market open is the break above your 146 for potential continuation towards the upside. So this is the key level that I'm going to have marked out on NVIDIA. And now we can play out the tape on the lower time frames. So as you can see here for Tesla, the key level that we have marked out is our 146.20. What we like to see on NVIDIA is the hold above our 146.20 for this continued push back towards the upside. So as you can see right here on NVIDIA, immediately we got back underneath this 146.20. Currently, you can see we're just kind of consolidating around your higher time frame key level along with this 1 minute opening range. What I wanted to see on this day here for NVIDIA was the candle close back above your 146.20 here on the higher time frames. If we're able to close back above, this will essentially be the confirmation that price does want to gravitate back towards the upside. So as you can see right here on NVIDIA, this is when we finally get that strong candle close back towards the upside. You can see that the buyers are essentially defending your 1 minute opening range along with your pre-market highs. Now we're having this strong candle closure back above. This is where I look to go long with a stop just to break underneath your original candle. Now I'm looking to target a 1 to 2 fixed risk reward back towards the upside. Now let's play out the tape. As you can see right there, we end up having a super solid push right off the bat. Before we go into the live session, I'm going to pop up my screenshot just so you guys know that I did take this in real time. Now let's head on to the live session. As for NVIDIA, I do like this one. Kind of lagging behind the overall market, but the higher time frame is still very much intact. The range that we have established, 142 and this 146. If you can break above your 146, we can see a really nice potential opportunity here on NVIDIA. As you can see, coming into market open, I like NVIDIA here lagging a little bit behind, but if we can break above your 146, show some strength above that level, retest, we can be looking for this continued push back towards the upside. Yeah, keep an eye out on NVIDIA. This one is looking like it's trying to break above this 146. That's going to be the key level on the higher time frames, 146 here on NVIDIA. Yep, NVIDIA, I'm looking at the 146 calls. It's breaking above your key level of resistance now and consolidation. Risk would be a break underneath this 146. So let's see if we can break above, hold, and then look for the retest on NVIDIA. So as you can see here on NVIDIA, showing a lot of strength within the first 2 minutes of market open. Now we're above our key levels, 146. What I like to see is maintain above your 146 for this continued push towards the upside. As for AMD, this one retested its 1 minute range along with its pre-market high. It seems like this one's a leader towards the upside. We'll also keep an eye out on NVIDIA here as well. If we can close back above, now it's going to be this 146.20. All right, let's see if we
Yeah,
can close back above this key level. I'll be looking at the 146. So for NVIDIA, if we can now close back above your 146.20, I'll be looking at the 146 calls for this continued push back towards the upside. Yeah, NVIDIA, I took some of the 146 calls on NVIDIA. Risk is going to be a break underneath this 146 here. The 146 calls on NVIDIA. So as you can see right there, I just entered in the 146 calls. Risk is just a break underneath this 146 key pivot level. And now I'm looking for this continued push towards the upside. So as you can see right there, what I waited for was the confirmation candle back above your 146. And now what I like to see is this continued push back towards the upside. Yeah, we just like to see a hold above this 146 now. As for the SPY, currently you can see SPY's retesting its 1 minute, retesting its 604. Let's see if we can get some continuation on the SPY and Qs. Qs high day here, similar with SPY as well. NVIDIA and AMD should be some of the leaders. At 147.22's next level higher time frame breakout, NVIDIA. This has room. Key levels 147.22 takes them off here. Really nice pop on the premiums. So as you can see for NVIDIA, super solid trade so far. You can see once we're able to reclaim back above your 146.20, we're having this nice push up in towards your 147. Key levels now is going to be your 147.20 and 148 here and above. As you can see, really solid push here on NVIDIA towards the upside. We ended up rejecting off this 148 key level and then ended up getting stopped out the rest of my contracts in profit. But this ended up being a super solid trade while using that confirmation entry. So with that being said, now let's go on to the next example that I do have. As you can see, we're on my second example here. And just to give us a little bit more context, the day previous, we just had news on Apple. Now we are pushing towards the upside here. Key levels I'm going to have marked out is your previous day highs. So as you can see, coming to market open, we have a multiple touches here in your pre-market along with your previous day highs. What we like to see is it maintain above your 207.40 for this continued push back towards the upside here on Apple. Now let's go on to the lower time frames and let's play out the tape. So as you can see for Apple, I have the first 5 minutes played out. The key level I have marked out here is your previous day highs 207.40. This is the key level I have marked out that it has to hold above if you want to see continuation. Now what we're also going to mark out here as well, which is going to be your 5-minute range. So you either want to see one of two things: the hold above your 207 for a push higher, or it's going to be the break above your 5-minute range for this continued push back towards the upside. Now let's mark out this high and now we can play out the tape. As you can see here for Apple, we are starting to build up these higher lows. You can see we are forming here a double top. Now what I like to see is really just maintain above this 208.20 for this continued push back towards the upside. So the levels I can have marked out is this full down close candle along with this 5-minute range here as well. So we have multiple confluences that we like to see Apple hold for this continued push back towards the upside. And you can see right there, so far the buyers are stepping in. You can see these lower wicks. We also get our confirmation candle here as well, where we close above our previous candle. This is where we can go look long with a stop just to break below. And now we can look to target a 1 to 2 back towards the upside. Now let's play out the tape. And you can see right there on Apple, we end up gravitating nicely once we're able to hold above our 5-minute range along with our 1-minute down close candle here for that continued push back towards the upside. Now let's go on to the live session that I had for this day. Your 616 and the reaction that we have off that level. As for some names that I'm interested in, Apple, this one has relative strength. It also had some news yesterday as well. So yesterday we had some news on Apple. Now we're kind of forming this wedge pattern, which you can see we're trying to break towards the upside. So we have news on Apple, we have relative strength, we have a higher time frame breakout as well. Key level for me is going to be this 206. So this 206 level is very key coming to today. You can see we already had a little bit of reaction off your previous day highs. What I would like to see on Apple is a hold of your 206. We could be looking for continuation back up and towards your high day and above, or it's going to be the reclaim back above your previous high day. So Apple's going to be one of my main watches coming to today above your 206. If we can hold above it, so as I mentioned, there's two scenarios, right? The dip down towards your 206, risking off your 206. And below that, or another scenario, which is going to be the break above your previous day highs, 207.37, for this push up and towards your 208.50s and above. So as you can see here on Apple, my game plan is fairly straightforward. I'm looking for the continuation on Apple, either the hold of your 206, or now it's going to be the break above your 207.30s for this continued push back towards the upside. Yeah, Apple, I took some of the 207.50s. I have a starter position in the 207.50s. This setup just a reclaim. Let's see if we can push. If we can break above your 5-minute range, then we can have clear continuation towards 208.50s and above. So as you can see here, I took the 207.50s on this reclaim above your previous day highs. A little bit more of an aggressive entry, but I took a starter position looking for this continued push back towards the upside here on this name.
Yeah, I ended up stopping at Apple too.
So I ended up stopping out of my starter position here as it broke back underneath this 207. I'm still very much interested in this setup for this potential continuation back towards the upside.
Apple still looks good setting up on the higher time frames. That one did hit high day, but as I mentioned, that one happened so quick. The 5 minute setup's still intact. If you can reclaim your previous day highs 207.39, that's going to be your key level for Apple, and then preferably the cues above your 550 as well. Yeah, I'm going to try Apple once more here. 207.50, same average as before. I like this a lot better here now with the cues bouncing. Higher time frame still very much intact.
So as you can see here for Apple, I'm back in the 207.50s. I like this entry a lot better than the first one now because the Qs is going to reclaim back above our key levels. Apple on the 5 minute is still holding up. We're building up these higher lows here as well. So now I like to see this Apple continuation back towards the upside. So as you can see there for Apple, really solid push after we're able to reclaim back above your 207 with QQQ reclaiming back above our 549.60s. Now what I'd like to see is really just a hold of your 208 for this continued push back towards the upside.
Yeah, if I sold some as well, key level for me now is going to be this 208.50s. I just like to see this hold 5 minute range high. That's going to be our key level for continuation. I personally would like to see Qs hold your 550, push higher, SPY, and then Apple push up in towards this 209 and 209.50 now. Yep, 209.50s.
But as you can see right there for Apple, really solid push after holding above your 208 for a push up and towards your 209.50. As for the QQQ, basically just a lot of consolidation, but right there, that was a good example of waiting for that reclaim above your previous day highs. There was also another entry here as well, which would have been your break and retest on the 5 minute, where you could also look for this continued push back towards the upside. But as you can see right there, that is the trade example for Apple. Now let's go on to the last example that I have for us today. All right, so we're on my final example here. We're on Apple a few days later. Just to give us a little bit more context, we're still very much bullish. As you can see, higher time frames are very much still intact. So coming into this day here on Apple, what I like to see is this continue push up and towards your previous day highs, or now it's going to be the break above your previous day highs 213.33 for this continue push back towards the upside. Now with the levels marked out, let's go on to the lower time frames. Now let's play out the tape. You can see so far within the first 5 minutes of market open, we're just consolidating inside of its 5 minute range. So what we can do is mark out your 5 minute opening range high, and we can also mark out your 5 minute opening range low. So now as you can see right here for Apple, we're starting to break above our 5 minute opening range high. We also do have room up and towards your previous day high here as well. So what I'd like to see is the retest off your 5 minute range for this continued push towards the upside. You can see right here for Apple, we're getting this immediate retest of our 5 minute opening range. You can also see the buyers are stepping in based off these lower wicks here as well. So this is where we can look to take a long position on Apple with a tight stop just to break below. And now we can look to target your previous day highs and above. Now let's play out the tape. And as you can see right there on Apple, we end up having a super solid retest right off your 5 minute range for this nice push up in towards your previous day highs. So as you can see, this is a great example of the conservative entry model that we did have, which was waiting for the buyers to step in. And with that being said, I hope you guys did enjoy that video. If you did, enjoy this full beginner's guide on how to start trading. I'd appreciate if you guys drop me a like and sub. And with that being said, I'll see you guys all next week for a brand new video. Peace.